Economies are powered by commerce, and commerce is powered by businesses. But who powers these businesses? Who journeys with them until their vision becomes success? At FSDH Merchant Bank, we are driven by the desire to empower businesses, equip individuals, and ultimately drive economic growth. From massive corporates looking to expand to MSMEs reaching for growth, we have been the link between vision and success for 10 years and counting. Because whatever success means to you, it's all within reach when you journey with the right partner. And if you let us, we can be that partner. Our innovative banking solutions are tailored to businesses and individuals across multiple sectors. We are a subsidiary of FSDH Holding Company, a foremost financial services group with over 3 decades of excellence. Through our innovative financial solutions, we are not just transforming people, we are transforming businesses, powering economies, and shaping financial futures. We are FSDH Merchant Bank, and we deliver simple, seamless, secure banking for you. Economies are powered by commerce, and commerce is powered by businesses. But who powers these businesses? Who journeys with them until their vision becomes success? FSDH Merchant Bank, we are driven by the desire to empower businesses, equip individuals, and ultimately drive economic growth. From massive corporates looking to expand to MSMEs reaching for growth, we have been the link between vision and success for 10 years and counting. Because whatever success means to you, it's all within reach when you journey with the right partner. And if you let us, we can be that partner. Our innovative banking solutions are tailored to businesses and individuals across multiple sectors. We are a subsidiary of FSDH Holding Company, a foremost financial services group with over 3 decades of excellence. Through our innovative financial solutions, we are not just transforming people, we are transforming businesses, powering economies, and shaping financial futures. We are FSDH Merchant Bank, and we deliver simple, seamless, secure banking for you. Economies are powered by commerce, and commerce is powered by businesses. But who powers these businesses? Who journeys with them until their vision becomes success? At FSDH Merchant Bank, we are driven by the desire to empower businesses, equip individuals, and ultimately drive economic growth. From massive corporates looking to expand to MSMEs reaching for growth, we have been the link between vision and success for 10 years and counting. Because whatever success means to you, it's all within reach when you journey with the right partner. And if you let us, we can be that partner. Our innovative banking solutions are tailored to businesses and individuals across multiple sectors. We are a subsidiary of FSDH Holding Company, a foremost financial services group with over 3 decades of excellence. Through our innovative financial solutions, we are not just transforming people, we are transforming businesses, powering economies, and shaping financial futures. We are FSDH Merchant Bank, and we deliver simple, seamless, secure banking for you. Economies are powered by commerce, and commerce is powered by businesses. But who powers these businesses? Who journeys with them until their vision becomes success? At FSDH Merchant Bank, we are driven by the desire to empower businesses, equip individuals, and ultimately drive economic growth. From massive corporates looking to expand to MSMEs reaching for growth, we have been the link between vision and success for 10 years and counting. Because whatever success means to you, it's all within reach when you journey with the right partner. And if you let us, we can be that partner. Our innovative banking solutions are tailored to businesses and individuals across multiple sectors.
Good morning. Good morning, ladies and gentlemen. Good morning, esteemed leaders of businesses, captains of industry, decision makers, and economy movers in the room. We're glad to have you here today on behalf of FSDH, the entire group at large. We're glad to welcome you to this very important roundtable, this conversation that is going to shape decisions for all our businesses as we proceed. Again, you're very welcome, and we're glad that you're in the room. We thank you for your time, and we appreciate you very much. But I'm just getting the conversation started. The actual welcome address is going to come in just a bit. Just to say that we are so glad that you are here. So people joining online as well, you're very welcome. This is the FSDH Mid-Year Economic Roundtable. Why are we gathered? What do we want to achieve with this conversation today? As we proceed, it will be clear. But let me welcome to the podium and someone who is in the right position to welcome you properly, given the caliber of leaders that we have in the room this morning and online as well. Please join me to welcome the MD CEO, FSDH Merchant Bank, the one and only Mrs. Bukola Smith. Thank you, Bumi.
Thank you. Good morning, everyone. Good morning, distinguished ladies and gentlemen. And thank you so much for joining us this morning. And thanks especially to those of you that are here in the room with us, and also to those that are joining us, have joined us indeed online. We are truly grateful to have you here today. On behalf of my colleagues at FSDH and indeed the group, the FSDH group, I warmly welcome each and every one of you to our 2025 Mid-Year Economic Outlook Roundtable. At FSDH, we are committed to delivering not just financial solutions, but also committed to equipping you all, our customers and our various stakeholders, with insights that is needed to make informed and strategic decisions. I'm sure you all agree with me that in our country today, and even in the world at large, we need to have those insights. A lot of things are going on, and this session today would hopefully throw a lot more light on things. Today's session is a reflection of our commitments to you all. Like you all know, we are halfway through 2025, and it is clear that both the global and local economy remains quite challenging, and so at the same time full of huge opportunities. Inflation remains elevated. Monetary policy in Nigeria and across the world are tight. Exchange rates volatility continues. Thankfully, in Nigeria, we've seen some level of stability, and a lot of things going on across the world. Yet there is reason to remain cautious, optimistic. For those who can read the signs, adapt quickly, and seize the right opportunities. Our latest Eye on the Economy report, which we're going to be discussing today, spotlights many key economic indicators. We will discuss a lot of them today. We have invited today a solid and well-grounded lineup of speakers and panelists, drawn from both the FSDH group and also our ecosystem of very trusted partners. each offering us a unique lenses, their own perspective on where the economy is headed and how we can position for success. And I'm sure that we're all looking forward to knowing how we can position for success. We hope that at the end of today's session, you will have a clear understanding of the key trends shaping the second half of 2025. You will take away practical insights for managing risks and identifying growth opportunities, and also leave here with significant and straightforward actionable insights that go beyond headlines. I'm really excited about the session today, excited about the speakers that we have, excited because I know that we are all going to be super enriched by the knowledge we will gain here today. Whether you are a policymaker, whether you are a business owner, an institutional investor, I do see some investors in the room today, whether you're a corporate leader, our goal is for you to leave this session better informed and significantly prepared to own the immediate future. Our goal at FSDH is to ensure that we equip all of our stakeholders with the right information that would help their business thrive. And for us, when our clients, our ecosystem thrives, we also thrive. As a trusted partner, our journey to success, your journey to success, is very key to us. And we remain deeply committed to supporting each and every one of you towards the most beneficial financial and investment decisions while playing our parts in building a strong economy. I won't take too much time because I know that we have a lot of things lined up for today's session. So I just want to again thank you once again for being here. You could be spending your time doing other things, but you've decided to spend the next couple of hours with us, either physically or virtually. And we thank you very much for honoring this invitation. We are grateful for your time, and I look forward to a very insightful and impactful session as we go on in the day. So I will say, let the conversation begin, and we look forward to an exciting time with each and every one of you. Thank you so much. Together, we achieve more. Thank you.
Together, we achieve more, indeed. To take us further, we're going to be diving deeper into our reason for being here. Every other day, a report is released. They're inside that, reports flying all over the place. Why did we decide to have this sit down? It's because someone informed must take the effort to translate numbers into insight. So to do a deeper dive into our reason for gathering today, you're going to please welcome with me the Executive Director, Global Markets and Institutional Banking at FSDH Merchant Bank, Mr. Akim Mohammed.
Thank you. Good morning, everyone. Thanks for joining us today. To our esteemed clients and partners, it's my pleasure to welcome you to our 2025 Media Economic Outlook Roundtable, which we've themed Navigating Nigeria's Economic Prospects in the second half of 2025. So whether you are with us here in the room or tuning in from your offices or homes, we're grateful that you've made the time to join us this morning. We believe conversations like this are more important now than ever. The world is moving fast, the headlines are quite heavy, and the decisions you make from investment strategy to capital allocation require not just data but clarity. 2025, you agree with me, has been quite eventful. The year started with the return of President Donald Trump to the White House, and shortly after the inauguration, the trade war drum started to beat. With new tariffs, supply chain disruptions, heightened tensions with China, Europe, etc. Global investors, some of whom we have in the room today, have been forced to rethink their exposures. Emerging markets have had to recalibrate risk models, while central bankers around the world are watching nervously. We are now witnessing two active wars. One has been suspended, and a potential fourth conflict in the Indo-Pacific between China and Taiwan. Oil prices have been swinging, interest rates policy is tightening in some places and pausing in others. And investor sentiment is shifting from risk on to risk aware. Here in Nigeria, we're also doing our own heavy lifting. We've seen bold moves from the now famous subsidies gone comment by the president signaling the removal of first subsidies to the FX reforms by the central bank. Investors, businesses, and everyday lives of people have been impacted by some of these actions. Inflation remains high, the naira continues to search for stability, and businesses are adjusting to a new and more disciplined operating environment. But in the midst of all the noise, there are still opportunities, and that's why we're here today. Our objective today is to cut through the noise and help you think clearly and act confidently as we head into the second half of the year, in spite of the headwinds, staring us in the faces. Very shortly, I'll be inviting Babajide Solanke to walk us through our 2025 media report. He's going to be breaking down the big themes around global macro trends, the geopolitics, the currency movements that we've seen, inflation, fiscal and monetary updates across global markets and our local markets, and how these are expected to play out in Nigeria and around the different markets in H2. After his presentation, Tiwalade Otufale, a tax partner at PwC, will be joining us to lend our expertise to the conversation, particularly around the recent tax reforms and their implications for businesses and investors. As we all know, tax policy has become a central part of Nigeria's economic reform agenda. And Tiwa's insights will help us to unpack what's changing, what to expect, and how organizations can stay compliant while remaining competitive. We're honored to have her with us today. After Tiwa's session, we will dive into 2 expert panel discussions, each offering unique perspective on the road ahead. The first panel will focus on economic outlook from an investor perspective in this era of higher volatility and fragmented geopolitics. The second panel will shift conversations to a corporate lens, looking at how corporates are managing supply chain disruptions, higher input costs, FS risk, declining purchasing power, amongst other factors. At FSDH, we understand that in times of heightened uncertainty like this, clarity and partnership matter more than ever. While we can't necessarily control global events or predict every market move, we remain committed to helping you navigate the complexity with perspective, precision, and purpose. Today's session is just one of many ways we aim to support your decision-making, deepen our dialogue, and walk the journey with you. Thank you once again for your time, your trust, and your continued partnership with FSDH. With this, I'd like to ask you to join me in welcoming Babajide as to present the H1 2025 macroeconomic report. Thank you very much.
Good morning, ladies and gentlemen. Akim is not an easy act to follow because one person that likes to put economists rooted on their feet. As economists like to, abstract significantly from reality. Thank you, the very distinguished Akim Mohammed. My job is not hard, but I will try as much as possible to simplify the economist's thought in simple language, because I know it's a room filled with businessmen and they don't like abstraction from reality. And who's going to help me with this slide movement? Are you going to? So before we get to the slide movement, I will do a bit of digression in history of economic thought, taking the cue from what Akim did mention, particularly the trade war. And the trade war, can be situated in that very beginning of the Bretton Woods. If you know what the Bretton Woods mean, the World Bank and the IMF. The World Bank essentially to help with development finance for countries, and of course IMF for balance of payment equilibrium. And the whole trade war is essentially about balance of payment issue, whereby one country is exporting and that country is importing. And when you are exporting and I'm taking your goods, essentially what it means is that I'm getting money, and when you are importing, my pocket is getting looser. And the implication of that is what Trump is against. And he's saying that China fundamentally should not be allowed to grow by exporting, while other countries import leakages in their own pocket, and China has to change that course. But beyond all of that is that same economic policy, essentially, that was granted Japan and Germany after the Second World War, rigged currency, export-led economic model. The same economic policy was granted the Asian tigers, South Korea, Taiwan, Hong Kong, Malaysia, and they did that same thing, WTO monitoring that scenario. Then China also given that concession. And it always happens with the situation of imitation, invention, innovation. And Japanese goods, 70s, 60s, were considered fake. Eventually, they became hallmark. South Korean goods, Taiwanese goods, Chinese goods, fake imitation, but they've left that imitation. They've gone to invention. They're now innovating. 5G, AI, and that is the canal of the Trump war against China, because it fundamentally changes the dynamics of the global economy. And we at FSDH also are very conversant with the AI phenomena, and we are playing a catch-up, getting ready for it. So that's a digression. And that is the global economy, if I can go to the second slide. And you can see, essentially, the tariff war. Since 1800, partition of Africa, First World War, Second World War, it's always issue about trade. Germany went to war, the Second World War, First World War, because of balance of payment problem. IMF was created to make sure that we will never get to that situation whereby we'll go to war again. And Trump has come using the American might, the biggest, the largest economy, the most militarily strong economy, and practically telling everybody it's no longer going to be business as usual. And there was a lull in that activity in terms of the trade war. Of course, Israel bombed Iran right on the soil. Iran retaliated, oil escalated, the Strait of Hormuz. There was a threat that 25% of crude oil that flows through that area is going to impact crude oil prices. At FSD, we cited that, eventually, external reserves will grow, because whenever there's war, it sounds bad, but whenever there's war, crude oil price escalates, and Nigeria benefits. External reserves grows. Other countries suffer. But there's not a balanced world anyway. We have the way we suffer as well. But it didn't last, because for one reason or the other, America got involved, bombed, heavy bombing, ghost, they called bombing, and everybody went back and calmed down. Appeared as if everything is over. About yesterday, day before yesterday, Houthi rebels working in Yemen, when they're working for Iran, you can't actually say bombed a Liberian flag, Greek-owned ship at the Red Sea. Now, Israel has retaliated again, going right inside Yemen and bombing right inside Yemen. But what it says in all of this is that, we can go to the next slide, please, is that Nigeria, from the global perspective, faces significant risk. But we'll get to that risk. And now that risk fundamentally impacts external reserves, impacts exchange rate stability, impacts inflation rates, ultimately monetary policy response, which will impact interest rates, and ultimately cost of fund for the business sector, cost of fund, even for the financial market, and opportunities in terms of assets to be acquired along that process. So let's keep on going, because we've essentially spoken about the IMF. I have to take us back into the journey. So nothing is new under the sky, basically. It is same old, if I'm allowed to say that. Dominance of the global space. Who are the guys, the dominant players? China is dominant. China's displaced the whole of Europe, displaced Japan, is now the second largest economy. America is the biggest economy. It's not going to just fold its hands and allow China to overtake it. It's got to respond. It's got to stop China from moving. The consequences of that is that commodity prices, given the size of China, given the capacity of China, please hold on here, in terms of manufacturing, in terms of demand for commodities. So we'll focus on demand for commodities, so we can narrow back to Nigeria, home. And demand for primary commodities, essentially crude oil. And the importance of crude oil for us, because crude oil is essentially a situation whereby the federal government or the Federation of Nigeria which is the federal government, the state government, and the local government, sell crude oil. They get dollars. The Central Bank of Nigeria buys that dollar from them, gives them naira. They share it at FAC distribution. So whatever happens to crude oil ultimately impacts the economy. So regional growth shows signs of fragility. Africa, to benefit. Let's keep on moving. Same old story from the global perspective. We're all aware about inflation rate escalated, kept going up globally. Monetary policy responses, including the Federal Reserve, the Bank of England, the Bank of Japan, the European Central Bank, naturally is to respond by higher interest rates. But we're all hoping, given the trajectory of inflation rate coming down, that they will all begin to slow down slow down the policy rates. But all of a sudden, it escalated, and they had to wait and see because of the Trump tariff war. Just about 2 days ago, Trump also further imposed 25% tariff on South Korea and on Japan. And I told you earlier on that South Korea and Japan were the Asian, Japan from whole school, Germany, Second World War, South Korea, from the Asian tigers, still copying that export-led economic model. And crude oil, so we've seen that escalation, like I mentioned, we saw a situation of economic outlook because of OPEC, because of Trump trade war and impact on commodity demand. And OPEC also, Nigeria is a member of OPEC, but Saudi Arabia is saying that they will not go Nigeria's route. And Saudi Arabia is saying that because they're losing market share and the agreement for them to cut output. Because OPEC is a cartel. And a cartel means that they can oligopoly. What it means is that they can only influence price. They can achieve the objective whether to control price or output. If they control price, it will be too obvious, so they take output. And Saudi Arabia is saying no, that they will begin to release more crude oil into the market. Of course, when there's higher supply, demand will fall. Please can we move to the next slide? And these are the countries in the cartel that have said they will begin to increase oil output. An implication of all of this, next slide, is that, like I mentioned, external reserve, which is the basis on which the naira stability hangs, depends on what happens to crude oil. Now, the path for crude oil as a commodity is that as the tariff war goes on, the world or global economy will slow down because of less demand for crude oil. The implication of that is that the budgeted crude oil output and the price are impacted, which means that external reserves capacity of Nigeria to defend the currency will become harder. Ultimately, that will impact fiscal policy, that will impact monetary policy. But in all of that, risk from geopolitical environment, Nigeria has done significant spade work, like Akim Ahmed did mention. And we'll get to that spade work. That significantly insulates Nigeria from that global economic environment that is bringing with it risk. Please, let's go on, please. I'll go to the next slide, please. So this is the dollar, global currency performance. So there's significant global risk. Let's just go on so that we can go into the meat because of time that we have. We've talked about instability, Strait of Hormuz, Iran war. Israel has started bombing Yemen again. Possibility of tariff, war escalating. Trump has said that the tariff will begin to be implemented by July 9. He's moved it again to August 1. So with some negotiations still ongoing. Just playing the game, just playing that, global leader game. Let's just move on so we can go to the domestic environment. Let's move on, please. Thank you. So how will the recent global developments affect Nigeria? Next slide, please. So this is the situation. Like I mentioned, Nigeria, since the return of the new administration, things are not done normally like we used to do them. And one of them is to first engage in fiscal policy reform, which includes the tax reform, which the tax expert from PwC has earlier introduced will come to dwell further on. Another one is monetary policy reforms, which brought pain, which still brings pain, but ultimately setting the tone for a more robust economy, for an economy that's able and capable to withstand global shocks. And I will get into those modalities of how we've been able to achieve that and how we'll be insulated from the global shocks that I've identified earlier on, coming from commodity price fluctuations, downward trajectory as estimated by everybody, including the IMF and the World Bank. It's also good to know that the multilateral institutions, independent agencies, are giving the government, particularly claps, in terms of the reforms they've done, even though they're painful, but they're necessary. And we will see how that will help to insulate us. But you can also see from this graph, this is the previous graph, that there's a deliberate attempt to diversify the economy away from crude oil in terms of fiscal receipts of government. Like I did mention earlier on, whatever happens to external reserve, whatever happens to crude oil, because that is where we get the significant receipts to fund government activities, to fund the fiscal activities of government. And ultimately, because of the role of the central bank as a monetary and exchange rate agent, to use to defend the currency and the cost of fund management in the system. So let's go on. Let's go on, please. So fiscal sustainability, like I did mention, I'm just trying to avoid the situation whereby I read all through the slide, but I believe that we have the slides with us so that we can run the time. And so when we look at all of that, and the impact on Nigeria is essentially through the oil channel, which is meeting revenue projections, and how do we achieve that? But what has happened is that we know that one part of the fiscal measure was to remove the subsidy on PMS, which is premium motor spirits. And the implication of that is that about 2.6% of GDP. If you look at that quantum volume of cash that's available to government, and that people have been asking that, why don't we see, why are we not seeing that money being in the system, or that money, flowing around? But there was, some hire of an NPC, and eventually 50% of that saving have started to come into the system from January, and as time goes on, they're going to increase the volume that comes into the market. And in all of my talk so far is to try to tell us that Nigeria is in a better place than it is in 2022 compared to 2024. And that space and that place we are is where we want to partner with you, is where we want to try to talk you through, so you can know that there are opportunities, like we all know, like everybody say, the potential is huge, the potential is enormous. Okay, this is off. And I just try to use my... Okay, it's back. Okay, let's go on, please. Let's try and speed it up. I'll let you know when to stop. Okay, so we've talked about finance. But fiscal policy, turning global uncertainty into opportunities. There's diversification of the economy. Like we say, we used to see fiscal receipts of government move from about 85% to about 62% in recent years. And that shows that there's fiscal consolidation, there's fiscal discipline. What has also happened with that, the devaluation of the currency in June 2023, so a situation whereby the state governments receive more money, despite the exchange rate's impact. And what has happened is that with that, what it means is that the state have more money to spend than they used to have. And we can see that saving happen in terms of government borrowing. Because after the Central Bank of Nigeria securitized the ways and means that we all knew was part of the previous government, and the federal government deficits, debt ballooned, we've seen a situation whereby government has significantly reduced that debt in terms of maturities, in terms of what they're willing to borrow, whether through treasury bills, whether through OMO, whether through bonds. We've seen that fiscal discipline, and that fiscal discipline is what's going to help us, to survive the risk from the global economy. Can we go to the next page, please? So how have key macroeconomic indicators fared so far in 2025? Next page, please. For the real sector, the rebased GDP will be out sometimes in July. But what we've said is that leading indicators that define economic activities of why FSDH should be ready, willing to partner with you. Why should I even come and invest? What are the opportunities? Are there opportunities? There are opportunities because you can see the PMI figures. The producers, Purchasers Managers Index. That is the leading indicator before we get the GDP figure. Economic activities are on and are robust and are growing in the Nigerian economy. Opportunities to grow, opportunities to invest do exist. And you can see all of that. Next page, please. Now, this is a topical issue, which is the consumer price index, because this is ultimately tied to the interest rate environment. And of course, interest rate, I'm sure you want to know at what rate will you be borrowing in the next 4 months, the next 5 months, in the next 6 months. Is it sustainable? Is it going to, should I take it now? Should I borrow later? And is it a good time to borrow, or is it a good time, to purchase FX so that I can insulate myself from possibility of volatility or depreciation in the future? And I will go into that section of the report. And the inflation rate has seen a consistent decline since the rebasing of the rebasing of the inflation figure. You may argue and say, why should they rebase it? But it's allowed. It's allowed because the economy has grown. The size, the composition has grown. And we are seeing a decline. But we are going to see a little bit of spike in June because of the resurgence of the problems in Benue and Plateau region, which has been curtailed to a large extent. So the path of inflation is going down. And why is this very important? This is important because, can we go to the next slide? It's important because the monetary policy of the Central Bank of Nigeria, which is the central bank organ responsible for setting interest rates that will determine how much you will borrow or how much FSDH will be willing to, lend you money, is anchored on inflation targeting. And what inflation targeting does, essentially, is to say that my interest rate will move in tandem or in agreement or the way inflation rate move. So everybody knows what the game is. So if inflation rate has a tendency to go down for the rest of the year, implication is that interest rates are going to, follow suit. And we've not had such policy coordination, such transparency for us to be able to determine the path of interest rate until the recent time. But it's clear that interest rates are going to decrease in the foreseeable future than increase. I will not use the word ceteris paribus to play safe. But things can do happen. But by all things being equal, there's a tendency for inflation rate to go down, interest rate to go down. Another key element is external reserves and exchange rate composition. So by implication, what has happened is that the Central Bank of Nigeria moved away fundamentally from the Emefiele-led central bank. And what they did is to play on what we call the impossible trinity in economics. And what that means simply is that every country must choose two out of these three. You must choose fixed exchange rate. You must choose out of fixed exchange rate, independent monetary policy, and capital control. Emefiele chose essentially fixed exchange rate. The naira was pegged. Naira was defended by external reserves, and of course, independent monetary policy, which means that the central bank can determine interest rate path. And said, no, nobody can spend that dollar card. You can't move dollar out, which was capital control. But the new government, what they did was to rejig that impossible trinity, because you can't choose the three, you must choose two. And said, okay, we will not do fixed exchange rate. Naira should float relatively. We'll have independent monetary policy, but there will not be capital control. Money can move in, money can move out. And we saw significant boosts in external reserves, and we saw a situation whereby external reserves net balance was about $4 billion, about $23-24 billion now, which also indicates that we will see stability in the currency into the future. But do not mix it up. A high currency is not an unstable currency in terms of exchange rate. It's the volatility of that movement that the central bank is concerned about. Deliberate policy to keep that exchange rate high to discourage import and to ensure that we diversify the economy so that the economy can be able to grow in a more sustainable path, and of course ration FX, to critical imports that we also need. So the opportunities exist in the system, possibilities for both greenfield and brownfield do exist. And the central bank and the federal government are partnering to ensure that that happens. So let's go on. So there's been reforms. Latest, of the reforms in the FX market, whereby we have the B-match system. And the B-match system is akin to the IRA window, whereby we saw about, it stopped at about 36% depreciation in 2017. And once the IRA window was introduced, until about the COVID era in 2020, whereby we saw another level of FPI's exit. But we have clarity, ladies and gentlemen. We have clarity in the path the economy is going. The economy of Nigeria is more predictable because the managers are laid all the cards on the table. There are no shocks in the system. FSDH, over the years, we've been able to navigate the system. Our numbers last year shows our capacity to understand the trend line, our capacity to be proactive because of the understanding. And you can imagine how that will even play out for both us and our partners, given the fact that the economy is now more predictable, is now more orderly. The signs and the macroeconomic indicators are no longer shocking in response. Monetary policy is understood because ordinarily monetary policy must not be shocking. It must be understood. It must be orderly. And that's what we have because the central bank governor laid his card on the table, told us everything he was going to do, and everything he said he was going to do, he has done them without shocking anybody. So everybody expects that this is how things are going to work out. But let's just run through the slide. I think I don't have a lot of time anymore. So there's reforms. Next slide, please. Real interest rate turns positive. Like I said, monetary policy is now anchored on inflation targeting. What it means is that once you are able to forecast the inflation part, once you are able to know where the inflation is trending, there's a possibility for you to know that this is where interest rates are going. And what they've done is to use the monetary policy tool called open market operations, which is called almost similar to Nigerian Treasury bills, which is a liquidity management tool in the system to guide us as an indicator to where the monetary policy or the interest rate part will lead. And we can see that after a very long time, we have a positive real yield, which means that when you take out inflation from your return on investment, it's become positive. It used to be very, very negative, using the monetary policy as a tool. All I am saying is that the macroeconomy and the outcomes are more predictable. And by being more predictable, that means ability to do business becomes better because businessmen don't like shocks. They don't like somersault in policies, which this government is working hard to ensure that they do not have somersault in policies. There's policy consistency, and that is what we expect to continue for the remainder of the year and into next year and beyond. Can we go on, please? Go on, please. Go on, please. So public debt. People are concerned about public debt as well. That has grown. But a lot of people do not also heard that growth is a result of devaluation of the currency, particularly from the dollar side or the foreign exchange or the foreign borrowings of the government. But what has also happened, according to the latest World Bank report, gives very high commendation to the government in terms of the way they've managed the resources, in terms of the way they've coordinated policies, and is agreed by everybody, both locally and internationally, despite the pain that an average Nigerian do feel on the street, that the economy is being stirred towards the way it should be stirred. And despite the fact that debt to GDP is high, it's about 53.7, but still within that threshold. The World Bank also did say that debt service to revenue, which used to be above 100%, is now at 40%. Which means that we have more resources for us to be able to do other things and provide that right environment for investors to thrive. Can we go on, please? The tax law, the tax system, like we did mention, a tax expert, a partner at PwC will come to shed light on that. So financial market performance. Can we go there, please? Okay. I'm not sure where we are right now. Okay, let's go. Sorry, fiscal and monetary policy update, please. Go back. Okay. No, go forward, please. Okay, let's stay here. We're not going to stay here anyway. Like I did mention, the monetary policy still anchored on the impossible trinity, which essentially, the Naira has been stable, hasn't it? Hasn't it? Relatively. Thank you, Hidi Small. Relatively stable. And that stability is anchored, like I told you, because monetary exchange policy is not shocking. The central bank governor has told us exactly what it's going to do. He has anchored monetary policy expectation. Unlike before, we didn't even know what exactly where we're going. We just wake up one morning and, there's confusion and all of that. And that has anchored expectation. That has warmed the hearts of foreign investors. And we can see that they release their pockets, they release their wallets. FPIs, though it's hot money, but we need it. We still need to have it. And we're using it. And even the level of dependency on that hot money, which is FPI, is reducing significantly because the federal government fiscal operations and fiscal activity is more robust as a whole. Ladies and gentlemen, I'm just going to keep talking on this economic report. But the key highlight of it, the key takeaway from the report, is that Nigerian economy is on a more sustainable growth path. All macroeconomic indicators show signs of positive trajectory. Look at inflation rates. It's still high. An average Nigerian, and I will not deny the fact that there's pain. But I think there are necessary pains for us to have a more sustainable economy, for your businesses to grow on more robust grounds, for them to be more rooted, for them to be more firm. Inflation is expected to be about 22-21% to end the year, 2025. Exchange rate, which we'll get into our summary report for our forecast, is expected not to be volatile, to still be around where it is right now, around 1,590. At the time, it got to 1,700. At the time, it was threatened to touch 2,000. And we saw choppy movements, even within that period, 1,007, 1,006, 1,005, 1,008. But now the stability. So the ability to plan is better. The ability to defend the currency is even bigger. Like I mentioned, net external reserve, where you take out all the owings, the money central bank is owing, swaps, etc., was about $4 billion in 2022. It's now $24 billion as of 2024 and growing. Leakages from subsidy. It's been eliminated. People say they can't say it, but they explain that the arrears of NNPC, now that institution needs to be sold eventually, hopefully. But they say the arrears is what they've been using it for. But 50% of that savings have started coming to the system ultimately. Exchange rate, like I said, is going to be stable. Inflation is going to trend. That interest rates, by implication, anchor the monetary policy committee decision of the central bank and how they perceive the economy in terms of price, stability, both domestic and external price being FX, I say will be stable, domestic price, which is inflation. It's also good to note that the inflation rate in Nigeria, about 48% of it, is locally produced foods. So people say that inflation, exchange rate is getting higher, why inflation has to go. No, don't be persuaded by such non-economic thoughts. Because the food element in Nigeria, which forms 48% of our inflation figure computation, are locally produced foods. Sorghum, millet, yam, cocoyam, potatoes, and all of the rest. But the problem is insecurity in the food producing areas that makes those food products being unable to get to the market. And once that is resolved, essentially we will have a more, even faster downward trend in the inflation rate than we have currently. Let's speed it up so that I can round up. Can we move on, please? So this is money supply, money demand. Essentially, just to mean how much money is in the system at any particular point in time, how much money is in the system will depend on how much FSDH can lend, how much the banking system can give the deficit sector of the economy. Can we move on, please? Can we move on, please? So financial market performance, we'll just skip through the slides. Just a little bit. And you can see, interesting, right? The yield on FGM bond is trending down, which means government essentially is borrowing lower. When the government is borrowing lower, it simply means that the government's financial health is better. That's what it means. Because external reserves growing, inflation rate is coming down, exchange rate is stable, government revenue is getting bigger and better. Wastages in terms of subsidizing foreign travel, medical, tourism, all kind of subsidy is eliminated. And you can see that trend line, which also suggests to us that interest rates are going to go down. If interest rate goes down, I'm sure you agree with me, the business people, even for us at FSDH, that is good for business. Ultimately. Can we go on, please? Can we go on, please? Let's go on. Because all of this just kind of shows financial market performance, which are indicators that you use to gauge how the economy is trending. And from that trend line, we can be able to have a situation of where should it go? Is it going to go up or is it going to go down? All indication is that all macro data are getting better and they will get better. And that is the message that we're trying to communicate essentially. So that's about, let's go on please. For the capital market as well, significant growth. We continue to see inflows of FPIs, FDIs around. So Nigeria capital market is still resilient. Can we move on, please? We'll get to a point in the meeting whereby we'll further talk about opportunities and how to partner with the public. So macroeconomic projections for 2025, and this is where I'm going to end my presentation. So let's stay here in a bit. So we have different scenarios, assumptions, and our best case is the moderate case. And that moderate case, oil production, which is about where it is right now, it's about 1.47, 1.50 million barrels per day. And if you look at the context of coming from, in 2022, coming from 600,000 barrels per day, and 2024 we're at about 1.5 million barrels per day, you can see the reason why the economy is going to do better and fiscal revenue is better for the government. Moderate reforms reform oil production, GDP, that's what we expected. Inflation, about 21%, like I mentioned. IMF expected to be at 22%. We're a little bit more optimistic. External reserves, to still stay at that 38, it's about 37 billion now. But because Nigeria has about $2.4 billion every year in the next decade, to pay for maturities of Eurobond, foreign borrowings, both the retirement of the bond and coupon payment. So with that, we're just a little bit looking at dynamics and say, okay, give or take, we'll still be about, but still significantly robust. Can finance up to 15 months of import. And IMF said just 3 months, which means we're significantly better. And finally, the final page. This is our macroeconomic indicators. This is where we expect them to end at the end of the year. For monetary policy, we expect it to, MPC, MPR, about 27%. Because essentially, there's the wait and look because of the global economic crisis and the need to be cautious and not to be too ahead of the curve and have to rewind our just policy and become chaotic, which is not good. And I think it's prudent that they have to be that conservative. It's also very interesting when you look at the Treasury bill yield curve. Beginning of the year, when FSDH did put this out, which is still consistent, even at half year. A lot of people thought it was impossible that we'll be trending towards this lower level yield. But we are around there. I think beginning of the year, we're close to almost 30-something% in some instances for those yield curve. Thank you, ladies and gentlemen, for your time.
Thank you, Babajide. That was quite detailed, you would agree. I know that our audience online have been asking, would we get this report? Yes, we'll share. We'll share. It will be all over our social media pages. We'll also email for everyone who registered. And if you're in the room, the report is right in your hand so that you can dive deeper when you get home. But what we'll do more in this room today is have the conversations that the report is throwing up, the questions on your mind, where should we be going, what should we be thinking, all of those will be dealt with today. To begin that conversation is a deep dive on something that I know is top of mind for most of us, the recent tax reform. What does it mean for your business? What does it mean for you as a person? What does it mean for the investors within your portfolio? What does it mean for you as an investor? Joining us virtually is Tiwalade Otufale of PwC, and she's going to be taking us through a quick conversation around looking in-depthly into the recent tax reform. Hello, Tiwalade. Are you able to hear us? And of course, it will be good to share our slides as well after the conversation is over. Okay, I can see Tiwalade now. Tiwalade, hello. Please unmute, Tiwalade, so we can get your voice.
Yes, sorry, I couldn't unmute for some reason. I think the host had, restricted access. I hope you can all hear me now.
Yes, we can hear you. Thank you for joining us this morning. And we'll just, thank you so much. We'll have you just go ahead into the conversation around the tax reform. Thank you.
Okay, all right, thank you. Can the host just help with the slides that were sent so I could perfect. Thank you very much. Good morning, ladies and gentlemen, and thanks for having me. And I will just move right on because I'm been told that I have this mammoth task of presenting the tax reform changes within the next 20 minutes. So I'll try my best. Apologies in advance if it's not as detailed as you would like, but we can have offline conversations after this. So we're all aware that on the 26th of June, 2025, President Bola Ahmed Tinubu signed 4 tax reform bills. Specifically, those reform bills are now law, and they were the Nigeria Revenue Service Establishment Act, which replaces the FIRS Establishment Act, the Nigerian Tax Act, which now repeals all the former laws that we have, like the Companies Income Tax Act, Value Added Tax Act, etc., etc. This is essentially the crux of our tax laws and consolidates everything. But just to set the scene, I think maybe the question is probably why this, big exercise. Now, in the past, some of you will probably be aware that one of the key concerns of the economy has always been about the multiplicity of taxes. Also, the fact that Nigeria had a low tax to GDP ratio. I believe we had about 10%, even when the OECD's Africa average was 18%. Nigeria was at 10%. It meant that we had outdated tax laws like the Stamp Duties Act, etc., etc. There were also ambiguities leading to increased disputes, and that meant that our laws needed to align with our economic realities. Therefore, this exercise by the Fiscal Policy Committee commenced, I believe, about 2 years ago now. So the objective was basically to consolidate and simplify our existing tax framework, to harmonize the administration across all the tiers of government, and also promote economic growth to ensure that, there's equity and, in a way, digitize the tax administration process. Given that, there's artificial intelligence and technology is now something that a lot of developing countries are using to help them with their tax process. Can we go to the next slide, please? Okay, so I'll crack on with, what are the changes? And the major question has been, what is the effective date? You would have seen on social media that, the chairman of the Presidential Committee, Taiwo Oyedele, stated that it would have a commencement date of 1st of January 2026. However, I state here that we have not seen a gazetted copy yet. But the chairman of the FIRS has also confirmed that, which means that, essentially, companies and individuals have 6 months to prepare for this effective date. And why is that important? It's important because from a process perspective, you would need to adapt your systems. Also, from a tax strategy perspective, you would need to update your tax strategy to ensure that you are now going to be in compliance with the new laws. Also, it gives an opportunity for current taxpayers to take advantage of any incentives that currently exist before that deadline. So the changes we expect to happen 1st of January 2026, and that would mean that, things to do with VAT and withholding tax will have that effective date. However, there are also questions around companies' income tax. That is, would it apply to my FY26 or would it be in FY27? Because the law says, we cannot apply laws retrospectively. I think our view is that it would be for FY26, meaning it commences from 1st of January, and it would be your financial statements for that period. However, my understanding based on conversations with the Fiscal Policy Tax Reform Committee is that it should actually commence from 2027. So 2027 YOA. But, like I said, we haven't seen a gazetted copy. There isn't any guidance that has been shared, but we can always communicate when there are updates. So let's go to the changes. No, let's go back to, yes, thank you very much. So we do have that the company's income tax rate is still 30%. It's 30%, meaning it's unchanged. However, I think what I must stress here is that there is a framework to reduce that to 25%, and it can go as far as 20% by way of presidential order. What does this mean? It means that the president, by way of an order, without going through changing the law as these reforms have come in place, can, by presidential order, reduce the company's income tax rate to 25 and subsequently 20. That's what we're hoping to see, to be honest, because that will also help with FDI and investors coming into Nigeria. However, I think the purpose of the committee at this time was not to rock the boat too much and essentially keep things constant, but with the hope that in the near future, our tax rates will come to somewhere around 20% and be as competitive with other developed and developing countries. Also, another thing that has changed is that we now have a development levy of 4%. So in the past, what you would have is you have tertiary education tax, police levy, and all sorts of levies, right? However, what has now happened is we now have a single development levy, and we've done away with all those police trust fund levy, Naseni levy, etc., etc. So this 4% of your development levy will take care of all those things that previously existed. Also, for companies, what has changed that is significant is the increase of capital gains tax. Capital gains tax under the current regime is 10%. However, that has now changed to 30%. That means that in your financial statements, assets that you have recognized deferred tax assets for, you would need to start thinking about revaluation of those because when you are disposing of those assets, they will now be taxed under a rate of 30%. And I guess also for investors as well, is now is the time to start thinking about, would you get more value by way of dividend, which you suffer at 10%, even though it's really an after-tax profit? Because on the other hand, what will happen is you will not you will have an increased tax rate of 30% when you're disposing shares in companies that you have invested in. Also, the proceeds less your historical cost of purchase. If you have met that threshold of more than 150 million in proceeds and more than 10 million naira by way of gains in a 12-month consecutive period, you are liable to CGT. So that's something that's worth noting. In the past, the threshold was 100 million, but now that has now been increased to 150 million. Something that's very new with respect to shares is also about the indirect transfer of shares. And by way of example, what I'll do is, try to highlight what it means for you. Now, in the past, if you disposed of shares in a Nigerian company, obviously, if they met the threshold, etc., then they are liable to CGT. However, now this new law means that if you dispose of shares of a company that holds a Nigerian entity, right, by way of that disposal of shares, it will become taxable in Nigeria under CGT, and that is Company B. Now, when you dispose of shares in Company B in Luxembourg that holds a Nigerian entity, what the tax authorities are saying now is that that transaction is liable to CGT in Nigeria. So that is basically to say, in the past, where people used to avoid CGT by solely disposing of shares in the Nigerian and by solely disposing of shares offshore, what they are now saying is disposing of those shares offshore now comes within the ambit of Nigerian CGT. Also, another thing that has been introduced, which is really new, is the introduction of minimum tax. In the past, we had minimum tax, which used to be 0.5% of revenue. Now that has been repealed. And what we have is a minimum tax, effective tax of 15%. But before people start getting worried, let me explain how that works. If you are a Nigerian company and your turnover is more than 50 billion, it means that you have a minimum tax of 15% of your net income, which has been disclosed or rather described as profit before tax. So if you do your tax computation or tax calculation and it's discovered that it is 15%, it is less than 15% of your profit before tax, will be paying that minimum tax instead, as that minimum tax is higher. This minimum tax also for companies that are parts of multinational enterprises, i.e., if you are a Nigerian company that is part of a big global group, your minimum tax rate is 15%. We also now have new rules called the CFC rules. These rules are basically for Nigerian groups that have in our previous legislation, we had these rules that used to say, if you're a closed company, i.e. a company that has less than 5 by Nigerian holdcos. So, as an example, if you are a Nigerian company or a Nigerian group, you have a foreign subsidiary, and that foreign subsidiary has good thing is VAT has been maintained at 7.5%. However, the FIRS put VAT. In the past, it used to be just manufacturing companies, but now what is put VAT? In the past, it used to be just manufacturing companies, but now what is essentially happening is we're saying companies that are basically that their products or services are not exempt, i.e., you are either VATable or zero rated. You can claim input VAT on services. So if, for example, PwC provides you a service, you can claim input VAT, or you can also claim input VAT on your fixed assets. For VAT as well, where you are in a VAT refund position, the tax authorities are saying that they can conduct an audit and refund you within 30 days. So that's a welcome development. For example, where you have VAT that you cannot offset against output VAT, this then gives you the opportunity to claim your money back rather than, trying to figure out how you get that money back. Now, briefly, I'll touch on tax incentives. We previously had the pioneer status incentives for certain industries in Nigeria. That has now been replaced by the economic development incentive. However, I think what's worth noting is that there is a transition period, which means that companies that currently have pioneer status will still continue. However, upon expiration of that, they will then move to the economic development incentive. And this priority in this tax act has been given to refining, crude, fertilizer, power utilization and mining industry. So how would this pan out in terms of the economic development incentive? What it means is that you will get a tax credit of 5% for all the capital expenditure that you have incurred, and you can carry forward that credit. So you don't lose that. You can carry it over for 5 years. So that will be the way in which the incentive is granted to companies. Okay, let's move to the next slide, please. Okay, so a lot of times when I do these presentations, people always ask, oh, okay, you're always talking about the companies, but you're not talking about me. How does this really affect my pocket, right? So I've just touched on the taxation of individuals on here. And essentially what this does is, in the new Tax Act, it defines what resident individuals are. And it also says that we are taxable on our global income. In the past, it used to be, oh, to the extent that you bring that foreign income into Nigeria, that's when it becomes taxable. However, that's not the case now. It's saying you are taxable on your global income. I think one thing that is critical that everybody's asking about, and I'm sure the people in the room are very interested about, is what is the tax rate? Now, the top line tax rate is 25%. Right, which means obviously for the HNIs, CFOs, CEOs, and people in the room, you will be paying more taxes. But I think on the backdrop of that is for equity. So you will have, your companies will probably have people that are paying less taxes, but people in the higher band paying more taxes. And on the left-hand side of this slide, I've tried to put together a simulation just to give you an idea of what the numbers are looking like. So for example, if you are an individual that you earn about 100 million a year, what you're looking at is that you will be paying somewhere around 4%, or 150 million. You'll be paying about 4% more in taxes per annum. But then you will see at the top end of this of the table that people will also be paying less taxes as well. So if you earn 800,000 naira or less a year, obviously minimum wage, you will not be paying taxes. I think what's also important to mention is that the capital gains, somebody says they're not seeing the slides. Okay, I'll leave that to the host. Also, what it then means as well is that from an income tax or from an individual's perspective, the capital gains tax rate for you when it comes to your disposals will be in line with your income tax rate. So if you are paying income tax at 25%, then your capital gains tax rate will be 25%. This is to move in line with obviously what is happening globally. Because there was a huge disparity between CGT, capital gains tax, and the individual tax bands. So this is now aligned. But remember, I had said earlier in my presentation that the president has the power to, by way of presidential order, to reduce tax rates. So if that is the case, where this is done, obviously that will also be applicable to capital gains tax. The final thing is, All right, I'll just touch on this again because I can probably sense people in the room are wondering and somebody zoomed in. So essentially what I was saying was at the higher tax or income bands, you will be paying more taxes. So if you're someone that you earn about 150 million a year, I understand the room is full of CFOs, CEOs, and the like. So I would expect, you are probably within the higher tax band. So the point is, if you are earning that, you will be paying somewhere around 4%. So if you look on the right-hand side of the table, it would be 4.13% more than you used to pay. So in the past, you used to pay an effective tax rate of 16.83% of your income. However, based on these new laws, you will now be paying 20.96%. And this is just to give you an indication of, how it will impact you in your pocket. Obviously, you will also have employees in your companies that earn significantly lower than that. But and the good thing for them is that they are now going to be paying less taxes. And this is just to reiterate the purpose of equity, and to say, look, we need to support the people. We need to have a progressive tax rate that helps people that are less, established. That's essentially what these new tax laws seek to do with the individuals. Okay, if we can just move to I hope that is okay. If we can just zoom out and maybe move to the next slide. Right. So there are a number of other changes as well, but I won't delve into them too much. As I said, I'm aware I've been given a short time to just give you a brief introduction. So basically, we had excess dividend tax, and now, with excess dividend tax, there was always the question about, is it when the dividend is declared or when the dividend is paid that the excess dividend tax will be applicable. Now it has been made clear in the law that excess dividend tax now applies when you declare the dividend and not when you make the payment. Also, we had interest deductibility rules in the past. It meant that a company could only take a deduction for 30% of EBITDA. Right? So if your interest cost is more than 30% of your EBITDA, you couldn't take a full deduction in that year. You could carry it forward for 5 years, but you could only have a maximum of 30% of EBITDA. Now, the thing that was a bit contentious was that it also included debt from your related parties, i.e. your connected persons. So if you are company A and you are held by company B and company B gives you a loan, that loan was being counted as part of, the base for this deductibility. But the new act that we have has now clarified, right? And the reason why it's clarified is because in the past, you could have situations where your connected person would help you get a loan from a third party. That loan from the third party was also counted as a connected person debt. Now that has been clarified and it's saying it's only interest cost on your connected debt that's limited to 30% of your EBITDA. We also had rules in the past about business restructuring. So if you had mergers or if you had acquisitions, there were timelines that you had to have held, you had to have been related, right, for more than 365 days to be able to transfer things like your losses, your deferred tax attributes, etc., etc. That is no longer a requirement. So it has made the rules a bit more beneficial and, clearer as well. I've mentioned this about minimum tax, basically just saying profits of foreign subsidiaries in Nigeria will need to pay that minimum tax of 15%. I think what's also worth noting with the new Tax Act is that, they are looking to ensure compliance. And by driving that compliance, they have increased penalties. So you have increased penalties that are 40% of your taxes that you haven't withheld for withholding tax, and up to 100% of taxes due as penalty. If you don't file your returns, believe it used to be 25,000 naira in the past. Now that is 100,000 naira and 50,000 naira for each subsequent month. Now, there's also clarity in the law around withholding tax for foreign companies that are providing services to Nigerian companies. Essentially, what they're saying is withholding tax is the final tax that they pay, and you must deduct withholding tax from that foreign service provider when you are making payments to them. There's also a 5% surcharge for utilizing fossil fuel, which is supposed to be collected by the Nigerian Revenue Service. And the last thing I will mention here is about permanent establishment rules. So in the past, what used to happen is foreign companies wanting to carry on business in Nigeria, like the engineering procurement contracts, will come into Nigeria, but they would split their contracts. So they would have some engineering, some they would do offshore, so that, the entire amount of the contract doesn't come within, being taxable. However, they have now introduced force of attraction rules, which means regardless of whether you split your contracts or not, they will be looking at the contract in its entirety with all the segments included, and that is what will be taxable. Next slide, please. So essentially, I guess the question is, what should you do? And I think this is the first step, what we're doing here today, having awareness of what's happening, empowering your people, sensitizing your management, and essentially having sessions where you can look at what is the impact. So the next step for you would be, obviously this is a very high level conversation, but like I said, I will be happy to engage with anyone that requires it, to have more detailed conversations as it applies to your company or your industry. But the first step is for change management is always sensitizing management, empowering people. Then the next step is that you assess. You do a deep dive where you're looking at what is the impact on my business, what is the impact on my employees, what is the impact on for the shareholders, and being able to prepare a holistic impact assessment so that you have clear action plans, and also you can update your strategy. And that moves into the next step on the slide, which is basically talking about you need to look at your tax strategy. You need to look at whether what the items that you need to change in there to ensure that you are in line and you are in compliance with the laws, as well as taking a proactive approach rather than a reactive approach. And on that note, I would just like to say thank you very much for having me. It's been a pleasure. I don't know if there are going to be any questions or if we can take that, separately offline.
Thank you, Tiwalade. Thank you so much for the session. It was quite expository. You want to clap? It's okay to clap. It's okay to clap. And just before Tiwalade goes, we'll take about 2 tax-focused questions while we are about to go into the conversation-led part of the event today. We'll just take 2 tax-focused questions, if there are any in the room or online. Anyone who has... Okay, I see a hand there. Please take a mic.
Thank you very much for that very detailed presentation. My name is Tunde Daramola. I work for Consolidated Hallmark Holdings PLC. I would like you to speak a little more about the issue of capital gains tax. What I hear is if you carry assets today that are undervalued, this is the right time for you to probably value them correctly and bring in the added value before the year end, so that this law does not catch up with you January 1st going forward. Would that be a correct understanding? Thank you.
Hello, Tiwa. Did you hear his question? Okay, while we are waiting for her, can we take any other question in the room? While we're waiting for her.
Okay, sorry, I heard the question. I was trying to unmute.
All right, please go ahead.
But yes, if I understand the question, it is the question is, should I, in my financial statements, go and revalue my deferred tax for my assets that I'm holding before 1st of January 2026? I think what I would say there is the conversations around the impact for your financial statements need to happen. However, remember I had said we need to wait for the gazetted copy, right? Which will say the effective date of the law. We need to wait for that because that is what will determine what that effective rate, what that effective date is. Also, that the rate that we have quoted of 30% is in fact what is in the law, right? And then you would update next year. Remember, we have said it kicks off from the 1st of January 2026, so it will be relevant for your financial statements FY26 on the assumption that you are a January to December year end. I don't know if that answers my question, or your question rather.
We are all waiting. Thank you very much, Tiwalade. Any other questions in the room? Any other questions in the room? It's tax focused. We're going to have conversations across the entire report, but just before Tiwalade takes a bow.
I see a question online, and I see a question asking about how the tax authorities will get information on, I think it's foreign income. I'm trying to zoom in, but it popped in. I wonder how the new revenue service plans to access citizens' foreign income for tax purposes. I think what is important to let you know is that there are various information exchange mechanisms for taxes. There are double tax treaties. There are things like the FATCA, right, which is the U.S. government which is done by the U.S. government, where your bank reports on your income. There's also things like the Common Reporting Standard, which is for EU countries, where there are your financial institutions that keep your accounts are expected to report. So, I mean, I'm not going to go into too much detail, but I think what I'm trying to say here is that the tax authorities have various mechanisms to gather data. And with the digitization of data and of processes, it may not be instant, but it is only a matter of time before things. I mean, it's like saying the IRS come after the American citizens and find out what their income is. There's nowhere to hide. It may take us some time, I can say, for us in Nigeria, but you know, it's coming. It's essentially the answer to that question.
Thank you so much, Tiwalade. Please a round of applause for Tiwalade Otufale. What session we've had with her. You know, when you sit before a thought leader and they ask, I have good news and I have bad news. Which one do you want to hear first? What's typically the answer to that? The good news first. The good news first. I think we've had both good news and bad news today, right? But to take the conversation further and dimension what really the news means and how it will come into your day-to-day, we're going to be having a panel that is focused on the investment aspect of the entire report and the affair we're about to enter into. Please welcome with me the head of Prestige Banking for non-banking financial institutions. Her name is Adaogo Okoli, to take this panel. She gets to moderate the panel and call up the panelists.
Good morning, everyone. I'm happy to be here. So time is fast spent, so I'll quickly introduce the members of the panel, and I'll be calling them in no particular order. We have a special guest, an invited panelist, Ehis Uzenabo. Let me just give a quick profile about Ehis. He's the MD of Shell Nigeria Closed Pension Fund Administrator. He has over 20 years experience in the financial markets. He was previously the Chief Investment Officer at the same organization. And he's a thought leader. He serves on the technical committee of the Pension Fund Association, where he engages with regulators and provide guidance on policy direction. So, Hayes, please welcome. Thank you for joining us today. We also have a lady on the panel, Adedoyin Allen. She's a financial services professional with over 15 years experience in the Nigerian capital market. So we'll be taking a lot of knowledge from that. She's an associate member of the Chartered Institute of Stockbrokers and Chartered Institute of Securities Investment UK. She's an authorized dealer of the NGX, and she's currently the Chief Growth Officer at FSDH Capital Limited. Welcome, Doi. Thank you. Finally, last but not the least, we have Mr. Femi Oshinobi, who is an investment analyst with over a decade experience in asset and fund management. He's a chartered accountant, a certified treasury dealer, and currently one of our portfolio managers with FSDH Asset Management Limited. So we'll be gaining a lot of insights from him as well. Thank you. Okay, so quickly, we've heard a lot from Babajide on the economic outlook, and I think for us here, it's to actually distill the information and break it down to levels where our investors can actually take something back home and begin to take action. So my first question will be to his. Looking at the global events and looking at the way investor appetite has been shaped as to happenings, what do you foresee in H2 as regards how investors, like portfolio investors like yours, how should they be allocating their assets? What is your advice based on the report that has been given today?
Thank you very much for 2025. And the typical asset classes, investors look at fixed income, equities, and alternative investments. But the interesting part of the conversation is that for the conventional asset classes like fixed income and equities, I don't think the Tea Party is going to be as colorful as it's always been. So that you will have to be a lot more disciplined, and beyond being disciplined, you also need a chaperone to hold your hands as you go through the second half of 2025. And it's not a time to be careless. It's not a time to be flippant. Because the environment, the market isn't what it used to be. We have big elephants in the room. We have unusual policy pronouncements. We have the likes of Trump, who will tweet and share updates from his social media handle with very little guidance from his cabinet. So that in itself is a big elephant in the room. And like I always say, the world is a lot more interconnected than it's always been, and the illusion of immunity for Nigeria or for emerging markets doesn't necessarily exist. So that what impact other clients would definitely impact us. Unfortunately, I don't think returns will be as decent as they were in the past, which is why you need intense discipline to go along which is why you need that level of hand-holding. And if you're looking for that return, perhaps the direction to really look at is, is alternative investment. So that would be my summary.
Okay, thanks, Ehe. So a follow-up to that, maybe I can ask Doi then. So you're the expert in, equities and all that. So can you sort of like break down what kind of recommendations would you say to someone who has a portfolio, based off of what Ehe has said, as regards where should you be overweighing, underweight, what kind of asset classes one should be looking at as an investor right now?
All right, thank you, Ada. And like Babajide said, for fixed income or macroeconomics, you'd see some level of stability. So from the financial market perspective, and if you look at the foreign portfolio inflows into the country, it has improved significantly. As at half year 2025, 8.05 billion USD has been in the country, which is almost the same figure for full year 2024, which is 8.53 billion USD. So we can see increased participation in the Nigerian economy. And diving into equities as well, if you look at the participation of foreign investors, it has also grown significantly to what we saw in 2024. So foreign investors now account for about 29.2% of participation in the equities market, which shows some level of confidence. And we've seen equities markets being bullish. New prices are being established. We've seen prices which are above multi-years high. And this bullish trend is expected to continue. And like he said, alternative investment, so you can look into equities. The consumer goods sector performed 52% half year, and we're still seeing traction there. The banking sector is also where to look into. So equities is still very attractive as we speak, and we expect it to continue, the bullish trend to continue towards the end of the year, till the end of the year. So you can position in the equities market, be strategic, follow trends, volatility, and invest in fundamentally sound good stocks. So that stocks that pays dividend, when you're ready to invest, you can consult with your investment advisor. You can reach us at FSDH Capital. We'll be able to give you recommendations tailored to your needs and hold your hands while you do this investing. Thank you.
Okay, thanks, Doi. I'm still with you. So, looking at the current reforms that GD has spoken about, FX reforms, subsidy removal, we've seen some capital coming to the capital markets, some funds coming to the capital market. So what do you think, what more do you think needs to be done to sustain this confidence? And how do you see, what do you predict as regards more foreign inflow into the capital market? Have we hit the cap, or do you still see further growth in that space?
All right, thank you, Ada. So for that, sustainability, we've seen stability of the macro environment. We've seen FX being stable. We've seen removal of subsidy. There's some level of certainty when it comes to macro, and that's what has been driving participation in the market. But if it's going to be sustainable, then all these macroeconomic, people are watching, wait and see to see if it's actually going to be sustainable, if the legal reforms or the macro removal of subsidy, you've removed subsidy, where are you putting the money? Are you putting it back into the economy? Is the economy growing? So these are the things investors are waiting to see. If it's going to be consistent and if it's going to improve, then it will be sustained. So if the macro reforms are stable, then we expect some level of sustainability in what we're currently seeing.
Thanks. Femi, you have something to add to?
Okay, thank you very much. And I think really spoken so well in terms of where the the investment asset classes are moving towards, especially that term of fixed income. We agree that the direction is downward, given what we have actually seen. And I think we've seen that in H1 very well. And that has actually, also impacted the positive momentum that we've seen in the equities market. I think we should have more of a sustainable, positive momentum in the equities market amid FX stability, right? And the fact that the CPI, it's just been rebased, right? And most of the prices that, or the what's it called now? The commodities, something like the product, like PMS, that we see that can, stimulate inflation pressure, has been factored into the index that will be referenced, because the reference index is 2024. So the pace at which inflation will, move up will be very slow, and that's what we have seen in the inflation figure from 24 levels now coming down to about 22.97. I think the recent figure that we have seen, and like Babajide mentioned the other time, the real returns now, is down there. So we will see a lot of movement into the equities market in H2 2025. Right. Thank you.
Okay, thanks, Femi. I think Jide spoke something very critical about, it's not about how high, but it's about stability. So I think what I've heard resonate here is that the expectation that there's going to be stability, not necessarily about interest rates, it's what is driving the market. So I'll go back to his and ask him. So where you sit, I think you have a more global view, and I'll be asking you as to what your views are on how the currency risk will be priced going forward by foreign and local investors based on what we have seen so far. What are your views?
Well, I think when it comes to currency, the concerns really seem to be behind us in the interim. About this time last year, 2 years ago, Nigeria was deemed to be uninvestable. If you speak to the average foreign investor, and I speak to them a lot because of how my portfolio is structured, for them it's the word uninvestable was a common word amongst the universe of investors I spoke to, and the concern was around FX and FX liquidity and availability. Thankfully, that whole concern is behind us. Again, I think investors generally, and consistent with what Mr. Sholanke, espoused a few minutes back, they're not concerned about appreciation or depreciation, so to speak, right? What they really want to see is stability, yeah? And if your currency is stable, you can plan. And whether you're an FDI or an FPI, what you want to do is that ability to plan. I sit in some quarters where people say, oh, I like exchange rate to come to 1.213. That's to whose benefit? It's not to our benefit, because what it means is that the guys in JP Morgan, Goldman, and the rest, who take a bet on Nigeria, will face the door immediately, and we all will be impacted. So with stability, everyone can plan, they can plan, we can plan. You don't deliver unusually astronomical returns to them, which fuels their exit. And so it's ultimately positive for everyone. In terms of numbers, I always will say nobody has that crystal ball or has that absolute clarity on, where FX will settle. But looking at what, has been put in place, both on the macro, on the fiscal and economic side, or monetary side, I think the expectation is that we will see some level of stability this year, next year, and that gives us a breather for a while. Unfortunately, as we begin to approach, 2027, politicians will do what politicians do, and then a reasonable businessman must factor what politicians do into their model, especially if such businessman or investor is operating from a frontier market like Nigeria.
Thank you. So, yes, stability. We have spoken a lot about that. So, Femi, let me come back to you. And so you sit on a portfolio management position. You look at asset classes. So looking at how inflation has started moderating, and we've started seeing the effects of, I think in my lifetime, real interest rates becoming positive. So what are your customers asking for? What are investors thinking as regards fixed income and other asset classes that you have in your portfolio? What are the views? What are they asking for now?
You can be sure customers are always asking for high rates, while they want to keep their capital preserved at the same time. So we've been finding a way to actually balance that, and I think we've been doing so well in that regard. We have our fund in the market. The money market fund is there, doing very well, and the growth we have seen in terms of our AUM has actually been that of a great one. So to quickly come back to your question, you see, the fact is you have to balance customers' investors' expectation in a way, because in 2024 we all enjoyed that high rate when everything appears not to be stable. But what I like about what the CBN and the Monetary Policy Committee has actually done, the monetary aspect of the economy, is that they've been able to buy time for the fiscal aspect of the economy. So rate was actually high. We saw our T-bills, the yield going at 28, 29, and we saw the FPI guys, they came in, and that actually really helped deliver good returns to our investors and our subscribers. So, but going forward is becoming a little difficult because rate is fast declining now. The T-bills, rates on T-bills that you see at 28 now is currently going for 20-21%, and investors are asking, why is it coming down? You want to reprice your liability. They are telling you, you gave me like high rates the other time. Why is it coming down now? So we are trying to actually balance that. One of those things we are doing is to throw our assets long in time when you see that rate is going to come down, and quickly reprice your liability. Those are the things that we are trying to do. Then we are trying to also look at for one of our funds, which is Balance Fund, that has actually returned very good yield. Investors are looking into that because it has the different variant of asset classes. We have equities there, and we play very well in that space. Most particularly, we've actually been able to look at the equity space and identify in a way of cherry picking some good stocks that we've put in that our portfolio, which has actually now yielded a whole lot. So I think balancing it is one thing we actually try to do, and we actually try to make sure that capital preservation, is always our watchword. Whatever we do, we make sure that you don't lose that your hard-earned money that you have entrusted us with. So,
but there's one area we haven't touched on, and I'll go back to doing the debt capital market. So we've seen a lot of companies that have stayed away from the market, and they're beginning to come back, to raise CPs and things like that. Maybe you can speak a bit to that. What are the opportunities for investors in that space, and also for companies that are looking to come to the market?
All right, thank you, Ada. So for the debt market, commercial paper, because of the high cost of raising money from probably the banking sector, most corporate prefers to raise funds from investors, individuals, because it's easier and is regulated, and it's cheaper for them compared to the stress they'll go to if they're getting loans from bank. And considering the interest rate environment, like we've been seeing decline, so it's also lower cost for them to come to the market. And we've seen rise in commercial paper. For those that don't know, commercial paper is similar to treasury bills, is a way of corporate entities, blue chip companies coming to the market to raise funds. And it's usually at a premium to treasury bills because of the perceived risk elements, because you're lending to an institution as against the company. So we've seen a whole lot of corporates coming into the commercial paper space to raise funds at attractive rates, which is higher than treasury bills market. For investors, it's a positive thing, because most of them have gone through due diligence, and like I said, they are regulated, they are listed of FMDQ, so the risk there is actually not so high, and you're preserving your capital, and you're getting something higher than what you typically get from treasury bills. So in the spirit of balancing your portfolio, you have equities in your portfolio, you have some treasury bills, and like he has said, sorry, I missed it, Femi has said, you should go long. So it's advisable to mix your portfolio. You have equities, you have some treasury bills, you have some commercial paper as well in your portfolio to maximize return.
Okay. So thank you. So I think this sort of tells people that this is a good time to be in Nigeria. So as a parting shot, I would like everyone, each one of you, starting with Ehis. So global rates are peaking, and idea of U.S. Fed hiking rates is muted. So our expectation that money is coming, and money will continue to come. So what does that? What as a parting shot? How does that? Is that true for you? Is that what you're expecting? And what does that mean for your portfolio?
What do you mean by money is coming? I don't understand.
Okay, so I'm talking about FPIs. So we usually, there's usually this fear and tension where when interest rates begin to go up in international markets, you see monies flying to safety or to higher yields. That risk has been there, that fear has been there, but nothing has happened now. And I think the view is that interest rates globally will still remain muted, and that has a positive connotation for us in Nigeria, because those monies that are here are likely to still stay. So is that your view? And or do you still expect that even more monies will be coming into the country in the near future based on what we have seen?
So as much as I'm concerned about, as much as I pay attention to what FPIs do, it's not the only compass I use when I decide, how I want to prepare for, to take investment decisions. I'm not exactly certain that I am very clear about, where that question was going. But if you want a parting shot, I'll give you a parting shot. I think the first thing to say is that it's a time to be more resilient, yeah, and not just be exuberant, yeah, especially because it's a truly connected world. Sometimes, it may not be by the umbilical cord, but whether via veins or arteries, we're connected and we're not immune to what happens, globally. And because of that connection, capital is fluid and it will go everywhere where there's return. If return is here, capital will come here. If return is elsewhere, capital will go elsewhere. So we have to be more resilient. We have to position ourselves properly. It's not the time for us to be exuberant, both from a portfolio manager's perspective and from a policymaker's perspective. I think another thing to be very conscious of is the need to protect investors' purchasing power. When we started investment management, the concept I understood was capital preservation, liquidity, and return. When inflation, who's the Armageddon, emerged and showed us, how inflation behaves, it became clear that if you're not protecting investors' purchasing power, you're not a fiduciary, or your fiduciary, status must be called to question. So it's something to take a look at and look at very critically. I've seen yields, rise astronomically in the last, few months, or maybe more than few months. But the real concern is, are we delivering real returns? In the absence of real returns, we're not doing anything. We're destroying purchasing power, so that as fund managers, as money managers, as fiduciaries, you must have build that discipline. What worked in the past will not work today, right? And that discipline must exist to actually deliver that real return. So you must create fats for investors to cover their bonds.
Thanks, Ehizaman, for bringing me back to earth. Okay. Yeah, that's very good. Doing this. Okay.
So, like he said, inflation rates is rising. People are looking for high yield. And if you want something that is similar or that can mimic inflation rates, the best place to get it is the equities market. If you look at the return for half year, the equities market has returned 16.6% just half year. So if you analyze it, you see where it is. So don't wait till the bus moves. You can still catch the bus. When yields are declining, you see foreign investors' participation. Even retail and institutional investors have repositioned themselves. They are back in the equities market. And like I said earlier, the bullish trend is expected to continue. So this is the right time to position yourself and wait for opportunities. Thank you.
I think, given that you need to protect investors' money is my job, and I think Elise, you actually directed that to me. I think, and we are actually doing that. Like I mentioned, maybe I should just give you this. Our balance fund return was about 65%, annualized, and 30% year to date. So to preserve investors' capital, deliver positive real returns, we are actually doing that. So, but what I just want to put across there is that H2 2025 is here, and it's just starting, and we are watching, we're tracking, I think one of those things that we are actually looking at is how the monetary side is playing out things. And I love the part that the market has been segmented. Omo market, we all know, is for FPIs in the banks. And we see rates at that level and what rate is doing in the T-bills space. I think for carry trade purpose, Omo market is likely to still be high. We need to defend our currency, and that we are actually tracking and making sure that we position, in the way that we deliver. I go back again, the positive real returns to our investors. Thank you.
Thank you, everyone. Thank you. Thank you so much. So we say, while we're optimistic, stay cautious. Speak to smart investors, investment managers. Thank you, everyone. Thank you, panel. Thank you, everyone.
A quick picture with our panel. I know there are questions in the room, but not just yet. We are going to have a full conversation around your questions as we progress. Please celebrate them. That was a wonderful conversation. Thank you very much. So we've seen from the investors' angle, I know that in the room today there are quite a number of managing directors and chief operating officers and chief financial officers who are thinking how we might corporate fare. So we're going to explore the conversation again from the corporate lens. And to do that today is a delectable lady. She's the chief dealer at FSDH Merchant Bank. Please welcome Taiwo Olajubo.
Good afternoon, distinguished ladies and gentlemen. It is my pleasure to actually moderate this second panel session for the FSDH Media Outlook Review. Permit me to introduce the panelists that will be coming forward. Okay, I'll start with our first panelist. He's a fellow of the Institute of Chartered Accountants of India. He has over 2 decades of experience in taxation, audit, banking, and other finance-related activities. Please make welcome Mr. Anup Drulia, the Executive Director of MINL Group of Companies. Thank you. Our second, you can come this way, sir. So our second panelist is a seasoned corporate banking executive with over 20 years of experience in banking. He has a strong record in corporate lending, investment banking, risk management, and deal structuring. Please make welcome Kunle Oshukole, the Divisional Head, FSDH, Divisional Head Corporate Banking, FSDH Merchant Bank Limited. Thank you, sir. And our final panelist for this session is the distinguished professional, a fellow of the Chartered Institute of Accountants of Nigeria with over 18 years experience in treasury. Please make welcome Jamil Kuku, the treasurer, FSDH Merchant Bank Limited. Very quickly, we'll be proceeding to the session. Thank you. Good afternoon once again to everyone present here. So good afternoon once again to everyone present here, and I would say it's a great honor to moderate this session, and I'm hopeful that we'll be able to gain much more knowledge from the corporate perspective. So I'll be starting my first question with Mr. Ano. And I would like to ask, In H1 2025, we've seen the impact of a lot of the FX reforms that have been introduced by the CBN, ranging from the introduction and the enforcement of the FX code, the introduction of the B-match, which has, driven transparency and enhanced exchange rate stability. So from your lens, we would like to understand how this has affected your operational strategy in terms of pricing, imports, capital allocation as well, just to have a sense of how that has shaped your operational strategy so far.
Thank you. I think the best thing which has happened to Nigeria in the couple of years is the FX reforms. No doubt about it. I know earlier when the bankers used to come to me and ask for a plan, I used to say to them, give me a direction, I will give you a plan. There was no direction. But yes, 100% kudos to the CBN and the federal government to bringing those changes. The stability which is there has really given us a lot of hope. We can plan our operations perfectly, and we can understand that now the past is over, where there has been so much of volatility and we could not predict anything. Yes, the pain was there because the devaluation had been very deep, but had it been delayed, it would have been brutal. So what I say is that yes, let us take the pain, and we have taken the pain, and the past is over, and definitely this FX reform is the best thing to happen to Nigeria. Yes, and today we can definitely plan things well ahead. Our costs, we can ascertain that, well, there will be not much of plus or minus in that. We can similarly plan for our imports. We can plan for our capex. It has given a lot of breadth to survive. Thank you.
Thank you very much. That's very visible because we've also seen a lot of FPI inflows on the back of this exchange rate stability. So a follow-up question. So are you saying that at the moment you're not very much worried about exchange rates such that you're not eager to cover your FX obligations? You can wait till they fall due, unlike in the past where we see people opening LCs and trying to just close out almost immediately for fear of exchange rate devaluing?
No, it's not like that. The volatility will not be there. That is the best part. But if we feel that FX is going to be stable, I think nowhere in the world the FX chart is a horizontal line. So let us take that and understand that yes, depreciation would be there. We feel that instead of appreciation, there is room for more depreciation in the FX as far as Naira is concerned. And depreciation is not a bad word. Depreciation is good, but if it is within a range of 4 to 5% per annum, I think that's not bad at all. As far as covering the FX is concerned, yes, what we feel is that FX position as on date should not be left open. It should be covered completely. That's what we feel, and that's what we are doing. Especially when the rates are now 15.30, I think this is the best of the rates. And people, if they think it's going to come to 1,200, 1,100, I think we are again living in a fool's paradise.
Okay, thank you very much, Mr. Ano. So I would like to ask Jamiu, I would like to ask him, given what Mr. Ano has said, what do you think is the role of the banking sector in rebuilding confidence in our foreign exchange market, just so that corporates and FPIs can thrive? And yes.
Okay, thank you for the question. I'll say that for the banks to drive what I'll call put back confidence to the market, I think the CBN already started that. They've done a very good job, try to sanitize the market, put hygiene back in the space, and we've seen that just from what you said just now, we've seen a lot of success out of that. You recently also got a rating upgrade from Moody's, and if we add up all of these things, the positive are very obvious for all to see. We have to sustain that effort really as banks. We need to also ensure that the license that has been given to us, we also need to support the CBN. One of the ways we can do this is to always make sure that the corporates get a price from us. When they call on us, we are always able to show them a price. When the prices evaporate from the market, it becomes a problem. And when they don't get price, they don't have visibility on FX, and that's how panic starts. And also as banks, we can also help them with edge solutions. For instances where they feel there could be maybe end exposures, they can kind of concoct some form of edge for them, their forwards, their swaps. Based on the expertise, we can always do this for them just to minimize the fear factor. Also, we also need to be very professional in doing our business. We have been saddled with responsibility. The skill set is there. We must always ensure that there's professionalism, and also as a market, we also need to abide by laws that guide the markets as professionals. Doing all of this will also redirect focus on the market. These are the things we see that kind of impresses the FPI to come in. For me, I would even say that FPI coming in is the first phase. By the time you start to get it into FDIs coming in, then you've built the confidence to a point. And I think that's what we should aim at. And all of the successes, maybe still early to start to celebrate, but I think we can build up on all of those things. Like the last speaker said, which is that the monetary guys have been able to buy time for the fiscal guys. At some point, even the fiscal guys. Okay, at some point, the fiscal guys will be called to account for what they've done so far. We see the reforms, the tax reforms coming up. That's one step in the right direction as well. We need to also continue to build on all of these things, just to continue to build that momentum. I think I think we should just ride the wave for now. The focus is on Africa, it's on Nigeria. We are a beneficiary of that capital. I think we're also speaking the language of capital right now, and people have focus on us. So as banks, I think we need to also support the CBN, where we are finding volumes that are massive for market. I think I also do like a one-on-one call to CBN to see how they can fill those orders without panicking markets. And these are things we can do to support them. We've had instances where we've gone to CBN to have conversations. We have a more listening CBN, unlike the past regime. So they're also willing to listen to ideas. And on the back of from privileged information I have, there's also some things coming up from the back end that's maybe not so obvious now. They're trying to sanitize the entire spectrum of the market, not just the FX market. It's now the transiting now to other segments of the market. I think by the time we can complete that phase, we'll have an entirely different market. And I think people like our customer here will be very satisfied and happy to continue to do business in the space. Thank you.
Thank you so much. So thank you so much, Jami, for that. So, Mr. Arno, the reforms are not over yet. They're still ongoing. That's essentially what Jami is saying. So the fixed income market as well is being sanitized. All of that put together are the drivers of the stability, not just what is happening predominantly in the FX market. And he also mentioned that we shouldn't rejoice yet until when we start getting, FDIs. So hopefully the impact of these reforms will see, more of that as we proceed into H2. So I think we can move into inflation right now. So I'll be going to you, Kunle Oshunkule. So for now, we've seen inflation starting to moderate. However, I think we're still in a high inflationary environment. So Kunle, I would like to ask you, what do you think organizations can do to manage cost pressures and still preserve margins despite the high inflationary environment?
All right, just before I say that, I think it's important that even the very small wins, we celebrate those small wins, and because knowing from where we're coming from, it was really, really scary, but I think a lot of things have moderated now. And talking about inflation, these inflationary pressures affect individuals out there because the companies are going to produce and sell to individuals. And when purchasing power has gone down, it means that the volumes that the companies are going to sell would also be impacted negatively. The companies cannot pass on all the costs to their customers. They can't pass on everything. So it means that inward, they need to look at how they reduce their costs and manage their costs effectively. And when you look at the costs that these companies are going have, there are operational costs, there are interest costs, there are FX costs. I think for the FX costs are something that is now quite stable. But like you said, we shouldn't over rejoice yet, but at least it's a good thing that has happened. Is how do we continue to manage those FX costs and ensure that we are not out? He has said that rather than keeping long positions and all that, you close out some of your positions as fast as possible. Those are very important. Secondly, there are interest costs that companies are facing, and at rates in the 30s, those rates are not sustainable for any company to borrow at and to fund their business at. When you have rates around 30%, no expansion is going on. You cannot do new asset acquisition, because if you do an asset acquisition at 30%, in 3 years you have repaid the principal. You know, that is not good use of money. So, and where there's no asset acquisition, it means that expansion and new technologies to reduce costs may be difficult, which is why opportunities around borrowing from DFIs, maybe local DFIs and all that, come in place, whereby you can have reduced interest rates so that at least those costs can be managed. It is also important that customers begin to look at issues around negotiating some of their supplier contracts, because at this time, what you would see is that because they can't transfer all those costs, what kind of supplier contracts are you having? Are there? We can look into it that would reduce our costs. That's also important. Look at their supply chain again. Look at their products again. How can they reduce those costs so that at least they're not going out of business? I think if you look at this, they would be able to fight those inflationary pressures. And finally, companies continue to do issues around scenario planning, looking at their costs based on regulations. If costs increase to this, what do we need to do? And if they do this, and I know serious companies in the country will continue to do that, so that they can minimize their operational costs, they can be more efficient, they can optimize it, so that at least they can.
The inflation-driven pressure, have you also been able to manage, your loan book, because inflation drives, consumer lending? So how have you been able to? So as well?
Thank you, Tayo. So with rates, like I said, in the 30s, if one is not careful, you could be building non-performing loans, and it's important that you don't do that. So one of the things that for us it's very important is particularly looking at the business we're funding and financing. Also, getting closer to our customers to understand their processes, even at this time, to ensure that all the variables in their business are looked at properly. You want to know what their cycles are, ensure that those cycles are tight enough. You want to know that when they're doing any form of investments, what kind of returns are these investments going to have? Because if you don't do that, there is a possibility whereby you can book bad loans. But also, working with our customers is to ensure that where there are opportunities for alternative lending, we present those opportunities for them. For instance, in the last few months, there has been some opportunities in some industries, and in those industries, they're able to borrow at cheaper rates, and because they're able to borrow at cheaper rates, you give them these opportunities, and especially once they take these opportunities, it reduces their costs, and once it reduces their costs, it's difficult to book bad loans. So because of all these things, it's just at this point we manage more with these customers. You're closer more with them, working, giving them alternative funding structures, Jamil had spoken earlier about issues around structures that you can do so that customers can have better returns. Thank you.
Thank you very much, Kule, for that. It was very insightful. So, Mr. Arnold, I would like to ask a follow-up question as well. So, because of the reduction in purchasing power, we've seen a lot of companies, repackage their items, bulk breaking, just so to drive consumer sales and all of that. So, wanted to ask, is your approach changing towards H2? Are you also going to adopt this marketing strategy, or what's your plan?
Yes, you are very true. In fact, what we can understand from the markets to whom we supply, the shrinkflation is the talk of the town. Shrinkflation, wherein you shrink your products, you reduce the size or you reduce the quantity, so that if you have 10 naira in the pocket and you go to the shop and you say it's 15 naira, you don't have to come back. That is the strategy people are employing, and it is running very good. And that's what you have to do it in this scenario in case of inflation around 22%. 22% on a rebased figures, because we know last year it was 33%, but it was rebased based on 2024 figures, and that's how we are getting a 22% inflation right now. So those strategies have to be employed to be in the market, to keep the market share, to beat the inflation. You see, the worst part is that you have to try to beat the inflation. How do you beat the inflation? If I'm hungry and I have only 10 naira, I need to see what can I give my customer at 10 naira? What can I give him 8 naira? And for the 2 naira change, what I can do? So that has to be there. And yes, people are working on it, and people who are working on it are doing fantastic. In fact, I know a few companies, well-branded companies, selling breweries. Their sales have come down at the cost of the low-end manufacturers. Even the bottles and all which we supply, the sales of small packaging bottles have increased. So you are absolutely correct, and that has to be the way out forward for the present. Thank you.
Thank you very much. So are you essentially saying doing that, adopting that strategy would drive your revenue vis-a-vis if you decided to maintain status quo and kept producing in bulk items?
You see, revenue has two aspects. One is the volumes and one is the value.
Yes.
With the devaluation, you will always get the value. But if you to protect your volumes, you need to have that strategy. Yeah. And volumes is there where you can keep your market share. Otherwise, you're out of the market. So yes, to drive volumes, you need to have this strategy. At least for the marginalized section, for the poor of the poorest, the middle class income and the lower income. Yes.
Thank you so much, Mr. Ano. Thank you. So my final question to you, Kule, will be that do you think this current interest rate environment is sustainable for lending?
No, the simple answer is no. Because really, I had mentioned earlier on that at these high interest rates, people will defer capex or expansion funding because those rates cannot, they don't really make sense. Really, these rates, government is crowding out other players in the market, because when you see rates yields at 28-29% with no risk, you probably just go and put your money there rather than all the risk. You do scenario planning, you do risk, you do market survey, you do all that, and at the end of the day you still have to borrow at 30%. So my point is, at these rates, it's not sustainable. But one of the things, at least, we continue to do is that as government continues to work on the issues around monetary policy, fiscal policy, it may take a while, probably say 22, 24 or so months. As those rates start to moderate, we should start to see expansion coming, because you also need money, funding for expansion in the market.
Thank you so much, PK. So I think the general consensus is, as we pivot into H2, there's the expectation that rates would, moderate from current levels. We have the MPC meeting coming up in about 2 weeks. The expectation from analysts is that there will be, a likely cut, which would further, drive rates in the economy. So I would just like for Jamil, the treasurer, to give his final thoughts What are his policy expectations for, H2, and what role do you think regulators or tax authorities can play to, build long-term confidence, investment confidence in our market?
Okay, I think that question is loaded in a way. So I think Jide spoke to a lot of the issues, expectations, and I think on the back of that, taking that as a background, rates globally, I think the issues are spread very evenly globally. Countries are dealing with inflation, that growth scare, will there be growth, and job, which everybody kind of, there's also a consensus on that. Now, we are still, the revenue sources we've tried to diversify. We need to also try to do more around that to continue to improve revenue. Because at the end of the day, borrowing is not a way out. You need to set out clear terms. Where is the money coming from? At the end of the day, it's all about where is my revenue? And after a while, or even outright not paying those things. So we need to balance it. And I'll say we need to balance it. And I'll say the wallet size is already shrunk. I mean, I think from what people are now trying to sachetize, it's called sachetization of products just to keep purchasing power. I mean, we've seen all of those. But going into H2, like you said, rates, we expect rates to come down. I think we have some headroom. We have inflation has come down to some extent. We still expect that by the time we start to release some numbers, we are looking at some GDP also, GDP rebasing. If all of those things start to come out, there's some sectors that have been added to the spectrum. By the time we do all of those and the GDP numbers improve, you'll see that the metrics and the ratios will now start to look good. Things like debt to GDP and all of those things, which then enhances your opportunity, your ability to borrow foreign funds. Now, the government will now have better pricing power when it comes to looking for external funding. And when those things come in, you realize that you can actually start to reduce your cost of funding, because really, that's a major pain point. We are borrowing a lot, and we are actually paying so much to service the debt. We need to look at how to reduce all of those. It's becoming a big pain on the budget and all of those. We need to also start to look for either to onshore production alternative. Rather than import, you need to onshore opportunity, let people start to import substitution kind of thing to save our foreign exchange and get us into some good revenue sources is what we should look at. For FX, we are 153 levels now. I think those are decent levels. There will be pressure points. We saw one, and I think more importantly is even how we handle the pressure point, more than that it's appreciating. During the tariff, I know we got to about 163 thereabouts, but it was very well handled. The frequency of interventions and all of those, and that's also what has added to the confidence boost that was seen from the offshore guys. I think if we can continue on this trajectory, we will be the destination of capital, because globally, the return promise out there is not so fantastic. So if we can give them the kind of OMO returns we give them, coupled with a stable FX rate, that's almost a flat of teens return or even 20s return, which is decent for most people. So, I mean, that still gives us some room to kind of welcome a lot of capital flows in our direction. And I think we can just continue to do this to year end, which I suspect they will do. Cutting rates might not be immediate. It might be Q4, because we still need to weigh the success very, very carefully before we jump into either a cut. So I'll expect them to still just wait it out a bit to like Q4 before they go on that trajectory. Now, cutting rates might not exactly be a bad thing. For the guys that want accrual, it might look like it's a bad thing. But for the guys in the market that are trading, that have positions to defease, that have profit to make, it's also not bad for them. They're looking at rates coming down actually, so they can make money. So I think it's just two sides of a coin, really. But in all, we want to reduce our borrowing cost, and I think we can do that by some of these things I've said. I mean, I think a lot of things are actually in our favor, so we can continue on this trajectory. People will make income, equities markets will kind of investment people do. But I've also seen that people are not they are not doing value investments. They are, I mean, when there's so much liquidity, there's inflation, people tend to just follow the crowds, buy things, which then kind of overvalues a lot of assets out there. So when you're picking asset classes now, we also need to be very careful on the optionalities, so you are not getting into an overpriced asset. I think that is a point we should look at. So for all of these things, I think the prospect is still very bright from where we are right now. For the nation, for the economy, it's still very good. We also need to kind of get very evangelical about the good sides of what we are saying, so we can all get on that message, advocacy of these things, so we can continue. Because at the end of the day, it's all perception. Globally, it's all perception. And if the US can be attracting funds at 5%, 4%, and they have a deficit of $36 trillion, there's something they're doing more than just the yield. Because it can't be an entirely yield play. At some point, you'll be paying so much. So you need to also try to get some goodwill to the market, so you can always benefit. And those will be my words.
Thank you so much, Jami. I think that was a loaded response. And he has said we should be evangelical about the good things that, you know, the Nigerian economy is doing, so we can attract more flows. I think that will be the end of this panel session. And I just want to use that medium to appreciate my panel members. And please, can we give them a round of applause as they get back to their seats?
Thank you very much. Please, let's file them for pictures. A round of applause for them, please. Please, let's file out for pictures. For pictures, please. Yes. Thank you very much. All right. So you came here because you had questions on your mind. Thank you very much. It's always interesting to take pictures at corporate events. You're like, should I smile? Should I have a straight face? Should I do my hands akimbo? What's the right posture? What's safe? Who makes these laws anyway? Who decides what's right and what's not? Thank you very much. That was a very insightful and encouraging conversation, if I must add. We are fixing eyes on the positives and trying to make decisions that count. You joined the conversation today because you had questions on your mind. Questions like, where's the economy going? How will it benefit me? I believe that some of the conversations have answered some of your questions already. But you may still have some more. The first, I believe, would be, how is FSDH positioned to help me, given all that I now know? And that's the first question we'll be answering. To answer that question is a delectable woman, a leader of leaders. Welcome with me, Executive Director, Corporate Banking at FSDH Merchant Bank, Sarah Mary Omogbai. A round of applause for her, please.
Thank you, Bumi. You know when they are setting you up. Good morning, everybody. I'm very happy to be here. I'd like to stand on existing protocols. I acknowledge my directors, my CEO, who's put me here, the MDs of my subsidiaries, as well as our virtual audience. And I'm really happy to be here today. And I'll be talking about FSDH advantage and how FSDH can help corporates scale in this climb. My name is Stella Maria Mogbai. I'm the Executive Director, Corporate Banking and Branches. I have put together a short presentation, and it's very short because we know the time has been well spent. So I'll go straight to the point. But however, like the saleswoman I am, I want to remind ourselves of why we are here, FSDH. And we went straight into what FSDH can do, what FSDH. So just to tell a few people, what's FSDH and who are we? Can I have my presentation, please? Thank you. Just go straight into slide 3. And I'll talk about briefly about FSDH. FSDH started in 1993. And we've been here for about 32 years. So we've been here for a very long time.
and we are going to be here for another 32 plus more years. We started as the first discount house in Nigeria, and that's why whenever I talk about FSDH, it's not by chance that we always have first in a lot of things. We are also in 2013 the first Nigerian bank to convert into a merchant bank in the second dispensation. We also were the first bank to start a holding company structure in 2019. So for us, we have been first of a lot of things. And I'll just talk a bit about our histories and milestones. We started, like I stated, in 1993. In 2005, we established a pension fund administrator called Power Pension. So that's a part of the FSDH group. In 2013, we became a merchant bank. In 2019, we moved into a holdco structure. In 2021, and just brief highlights, and I'll send a presentation, we started a few decks that were very important to us. The healthcare finance desk, agri-allied desk, and a very favorite child of the business, the women in banking proposition with the DEX. In 2022, we started our custody business, the FSDH nominees. And in 2024-2025, we started our FSDH Infrastructure Debt Fund, which is under the FSDH Infrastructure Company. So, and that's under our asset management. So that's a bit about us. And we currently have a group structure. And the group structure, we have a holding company, we have the merchant bank, and under the merchant bank, we have the custody business, we have the FSDH asset management, we have the FSDH capital, and we have Power Pensions. And why is this so important for me to talk about us in this way? It means that we can serve every aspect of the banking industry, cradle to grave. So we start cradle from FSDH asset management, so I hate to use the word grave, to retirement with Power Pension. And in between that, if you have debt solutions, if you have equity solutions, capital market, you have from the merchant bank to FSDH capital. So it's so important to say this. So we know that everybody in this room and online actually can do business with a part of FSDH group. Thank you. So what are the industries we serve? We have, and I always like to point this out because people say, what does FSD do sometimes? We have our agri-allied decks, we have our, what we are known as, which is our manufacturing decks, and that's mainly, where we speak FSDH and corporate. We have our fintech decks, we have our energy, oil and gas, and we've actually been very pivotal in actually the establishment of some of the current largest players in the energy climb in Nigeria as a did. We have our value chain decks that we actually use to support our FMCG decks. Healthcare, women in business, and our latest baby, our Chinese desk. So in FSDH, we face these industries and we use specialized tools, products, people to face these various industries. Now to the topic at hand today. Now I've done a bit of marketing about us. So the topic at hand today, and we've spoken a lot about H1 and the forecast for H2, and I'll just do a bit recap. For the forecast of H2, what have we said? We stated that interest rates, we expect interest rates to trend downwards, not to go down as fast as our corporates expect, but to trend downwards and get better. Inflation, we've stated it is moderating. It has moderated. There was a rebasing. It's moderated. FX concerns. Well, the important thing for us, and even the corporates actually admitted it, that for us is not, there's been some form of FX liquidity, and that enables them plan. The global economy, the tariffs, global wars, it is what it is. However, the thing is, what are corporates doing about it? And I'll go to my next slide and speak about this straight to the point. How can corporates scale? For us is first thing, FX, currency risk. What can we do? You can use right now, because there are a lot of liquidity, but even in the absence of FX liquidity, you can always do forwards, swaps, LC, structured hedges, and we have Jamia and Kumle talk a bit about that. So we use that to manage the impact of the market risks Once you do your hedge, you can price your product. That's the most important thing. You have an idea of what the cost of your product is. You add a margin and you can price the product. And that's what FX liquidity actually brings to the table. You now, with the global wars, what are we looking at? Localize your supply chains and look at alternative supply chains. And those are the advices we are giving to our clients. Reduce import dependencies, FX dependencies, localize your value chain and reduce your FX dependencies. Also, look at other climes. We can talk about if you were typically exporting or importing from US, China. We talked in FSDH, we have a Chinese desk, so you can come and talk to us. And also in our treasury has the ability to do USD and CNY LCs and structures. So I just want to put it out there. So you don't necessarily have to open your LCs in your USD with FSDH. You can also open your LCs in now what's the word? A currency that has been increasingly in use, which is the CNY. So talk to us and we'll tell you how we do it. Then you can, one of the important things, and it was spoken about by the second panel, looking at efficiencies. How do you look? So for us there's the use of technology. Use technology. You now start digitalizing your technology processes. How do you do your collections? How do you stop cash? In fact, when I sit down and talk to a few of my clients, I say, you know what? Your bank can be your back office. You have 30, 20, 100 people in your back office collecting cash. Drop that. With one word, if you tell your distributors, drop cash, but I will not take cash. You know what you do? Go and pay into bank. Most of your bank statements and your bank systems have reconciliation modules. So at the end of the day, global, centralize your treasury. Use that at the end of the day, just say, what's my statement? With your statement, one person, if the job 20 people are doing, one person can do that. And you have to start looking at internal efficiencies. Those internal efficiencies increase your manage, so your margins. Use APIs to do your collections. We are doing it with some of the top corporates in Nigeria currently using APIs. And what do APIs? We integrate into the banking systems. Let me just integrate into the customer systems. So all the collections flow simply. At the end of the day, they reconcile. As the systems go down, 1 second after the systems go down, they have their reconciliation statements. So those are the kind of things you have to start looking at within your systems. Mr. Anil is looking at me. Come and talk to us and I'll tell you how we'll do it. Protect liquidity and put idle cash in use. And that's so important. If you have any idle cash, what do you do with your cash? At the end of the day, have a system. You know, cash, end of the day, place it, have some yield. So, you know, if you look at the you look at the financial statements of some companies, particularly some corporates, you see income from investing activities. In fact, there was a corporate I was having a conversation with. I said, you made more money from investing than you made from your usual business. You know, that's what they do. So if you have an efficient treasury, any money at the end of the day, instead of sitting it over and sleeping, you put it and get a yield or an interest for it. Leverage capital markets, and we've spoken about it. You know, currently, because of the high interest rate yielding for debts, what are people doing? A lot of people are, making use of the CP market. There's been some kind of regularization with SEC now, but you can still do that. With the CP market, you're actually going to get debt capital at a cheaper price than current commercial borrowing. And you can take advantage of that. And one of the important things is do not have a strategy that is cast in stone. When the rates change and commercial rates get better, you go for that. And the lucky thing is, like in FSDH group, if you want to raise a CP, we have FSDH capital there. We also have people from the bank and asset management as well as capital can help you raise. So you have people that can help you structure and you have people that can help you raise the money. And you just sit there in the comfort of your office or your house. And sector diversification. And it's something that is really important for my corporates. A lot of corporates have seen, I'm in manufacturing and that's what I have always done. You also have structures. You have those same supply chain structures. You can use them reverse. So, for example, if I'm importing, you can use that same structure, tweak it a bit, and export. Can you start exporting and get a bit of foreign exchange? A few people are doing that. If I was in only one part of the sector, can I use my same structure and go to another part of the sector. Those are the kind of conversations that corporates need to scale in this climb. But the important thing and overall is you have to continuously looking internally and externally and saying, what can I do in this climb? Luckily, and that's what everybody has said, there's been some form of stability. Exchange rate, interest rate will trend down. Inflation will kind of trend down. So you can plan, how am I going to do better? And my next slide will be, how can FSDH partner? So we talked about cash flows. For us, is in terms of foreign exchange, in FSDH, we have a very, very, very robust treasury and global markets. And we can sit down with you and plan, you can actually have an FX strategy. And the FX strategy, I want to diversify. I want to do some of my trade in LCs. I want to do some forwards. I want to do some swaps. I want to do dual currency. I can want USD, and like I talked CNY, I can do that. The lucky thing is, like I stated, there's some form of liquidity. So with some form of liquidity, there is stability, and you can plan with that. And that way, you can also determine what your margins will be. Once you lock into those products, you can determine what your margins will be. So we have a lot of structured finance and FX hedging products that we can use to assist you. Value chain financing. I had spoken earlier about, we have a very robust value chain DEX in FSDH, and we use it to support our FMCG business and our other multinational businesses. So we can provide working capital for your distributors, your suppliers, your contractors in such a way that you, the corporates, benefit from that, and there are different forms of that: guarantee, stock finance, working capital, and they can help you. So that way you drag the cash to you while FSDH provides the support for your downlines. And you can talk to us about it. And I've spoken a lot about digitizing your treasury and payments. We have talked about our virtual, our API type accounts for collections. And the important thing is, and I tell my customers, your bank can be the part of your finance. And these days with automation, it is so easy to do that. By the time your systems go up and come down, you should have your statements and do your reconciliation. And that way, most of your people in your back office, you will be able to deploy them into more other uses. Liquidity preservation, I talked about that. We have different forms of accounts that can, you can make monies from, as well as unlocking cheaper long-term capital. And in long-term capital, I talked about FSDH capital, and the ability, FSDH also has the ability to raise CPs, all kinds of debt capital to fund CapEx expansions and acquisitions. And I'll talk about other opportunities. We had spoken about borrowing cost. That was, a very topical issue today. Even though interest rates will ease down and go downwards, they will not drop as high as most of our corporates expect. But with us in FSDH, what we've done is we've had a lot of, partnerships with a lot of DFIs. And for some sectors as well as some corporates, we are able to offer DFI financing. We've offered financing to DFIs as low as 9 or 10%, from DFIs to as low as 9-10% to upper regions of maybe 15 and 16%. So you can come and talk to us in those kind of financing. I mean, a week ago we did an amount for about 15% for particular structures. Then for women in business, our baby, we're able to offer those kind of rates till now. So for us in FSDH, we can actually offer lower rate financing for you, so you can lower your borrowing costs while you can either lower or blend while you are still looking at commercial pricing come down. But our expectation is towards the later part of the year, commercial loans will actually come down. In fact, they will come down lower than what we expect from the MPC pricing. Then in terms of improved FX, we have stated it, there will be liquidity. In FSDH, one of the things I tell my customers, even the days of hard FX liquidity, was FSDH will always support you. And most of the corporates attest to that. You come, we'll give you your fair share of FX. And that is an FSDH pledge to our corporates. So we're able to support you. So liquidity does not become an issue. And we'll be able to support you with liquidity
in terms of your USD and, like we said, other currencies. Right now, we are able to do CNY. So if we are seeing a lot of imports coming from that area, we are able to support you in your CMI liquidities and structures. And I'll talk just very, very briefly on our industry solutions. And what do I mean? For example, in the agri-light space, we have structures around export structures, lending, export forwards, so for the exporters. And one of the things we're also doing with the exporters, working with them to ensure, because they are mainly seasonal products. So towards the part of the year, the exporters are in season, they make money. After some time, they don't. So we are working with them on ensuring that they have year-round products and structures. We also have specific funding for our energy sector, both upstream and downstream, advisories, as well as our new baby on the block, which is our infrastructure fund. And we have a few clients that are also looking at that. We are looking at funding, very, very longer term funding under the FSDH infrastructure debt fund. And I think we are currently doing some transactions in power and healthcare. And this is what we call the FSDH advantage. Sorry, just 2 more slides to go. This is what we'll call the FSDH advantage for us. We look at it as a handshake. We offer you customized onboarding, and I will talk a bit about that. We can onboard you remotely. We can onboard you physically. We can onboard you in English. We can onboard you in Mandarin. So whatever way you want to, we can onboard you. So whenever I tell people in FSDH, there's one of our words which we use, we are innovative. People say, really? I said, that's why. I say, come to FSDH. Anyway, remote, anyway, Mandarin, that's our current, we are onboarding people in that. So that is a process we are currently working on. We have partnerships. We stated it. We have partnerships, both local and foreign DFIs, and that has been a very strong advantage for us, even in the crisis, COVID crisis. FSDH, some of the foreign partners still gave us more money to lend. So that's who we are. We have monies to grow your business, and what we call resilient money. What does that mean? Longer term money, and that is so. If you need money for a long term funding solutions, FSDH is there. We have tailored financing, and I'll just speak a bit to that. So tailored financing, for example, we have a financing for fintech and financing for women-led businesses. And it's not only in financing, we have for our women-led businesses, we have grants. We give you financing at cheaper costs. We handhold you through the stage of your businesses. And we have a lot of energy-led solutions. I've spoken a lot about our e-channels and our APIs and our collection products. And finally, we are a group. So when we stand as FSDH, we don't stand only as the FSDH bank, we stand as a group. We have our capital business, our asset management business, our PAL business, our pension business. So as FSDH, for each and every client of ours, including our corporates, we are there for you. So thank you. And last slide. You can meet us at any of our locations, Lagos, Abuja, and Port Harcourt.
Thank you so much, ma'am. Thank you so much, ma'am. That's the FSDH advantage, the trusted partner on your journey to success. Whatever stage you are at, there's an FSDH solution for you. So if you still have questions in the room before we leave today, okay, please let's clap. I see people are trying. Should we clap? Should we not clap? Please clap. Let's clap. Thank you very much. If you still have questions in the room, I know somebody was talking about risk online from the first panel. But I believe that has been handled sufficiently. Are there other questions in the room before we call it a morning today? An afternoon. Are there other questions that have not been answered? Because in curating this, we're thinking around what will be the issues on your mind and trying to cater to them through all the phases of the conversations. But if you have questions, there are 2 ways to go about it. We can have a quick conversation about them here now. Or you can speak to somebody from FSDH who can give you personalized, in-depth, answers and next steps to drive the solution that you're looking for. I can see that we're having conversations on the lines. Should we say that we are at a good place? All our questions answered. Fantastic. That's the FSDH advantage. We leave nothing unturned. Every spot is blocked. So to wrap this up, because it's been very, very insightful. We've had so many wonderful people in the room, so many protocols. If we wanted to acknowledge all the VIPs, we'd have to call every single name in the room. So many MDs and CEOs and CFOs, and we really appreciate your time. To appreciate you properly, please welcome with me the MD FSDH Capital for the closing remarks, Mr. Abimbola Kasim. Welcome, sir.
Good afternoon. I think we're almost spending 3 hours instead of the 2 hours we planned to. So I'll make my closing remark very, very, very short. You would agree that it's been a very impactful session. So I'd like to say a big thank you to everyone that has participated in one way or the other. Your presence, your invaluable contribution. We've spent the past 3 hours reflecting on the realities of the Nigerian economy, particularly the opportunities amidst the plenty challenges. But one thing from the insights we've shared today that we can all agree is that in as much as the future may be very cautious, our outlook for the future may be very cautious, we'd all agree that it is very, very far from being bleak. That we must all agree. The conversations have been very, very intellectually stimulating, but not that, it's been very, very practical. Your insights, all the panelists, I think they poured from their hearts, they gave us practical insights. So we didn't do theory, we did it, we gave you what is on the streets. So we hope that you'll be living here with new perspectives, renewed clarity for how to move forward in the months ahead. At FSDH, we believe in insights being the foundation of anything we do. Insight being the foundation of good strategy. So this belief fuels our commitment to creating platforms like this, where decision makers can pause, reflect, and plan from a place of knowledge. So we don't do guesswork. We don't encourage guesswork. We encourage that we all come from a place of knowledge. So again, to our esteemed panelists, thank you for your time. Thank you for your candor, your brilliance. To everyone who has joined us physically, we have no doubt that there are other things you could have been doing with this time. So we are very, very appreciative of the time you've spent with us. So we say a big thank you. To our online audience, we appreciate you and we thank you for being engaged. So as we step into the second half of the year, we are confident that businesses and institutions like yours will continue to lead with agility and with foresight. So thank you, and together we achieve more.
Thank you. Together we achieve more. So don't be in a hurry. Let's take pictures. Let's grab a drink if you want. It's been quite a wonderful event. Thank you so much for coming and for staying till this point.